All right, is Athena here? Ah, there she is. Hi, Athena.
Hi.
Good morning.
Morning.
All right, so I'll pick on you now. So Athena convinced me that you guys really keen on studying more accounting.
Yes, we concur.
Yeah,
100%.
you want to do really well on the exam. And so you need an extra week for the exam. So I said, fine, we'll see if that experiment works. So so I'm gonna move the exam 1 week back. So instead of it being due next week, it will be due the week after. But the project itself is still due next week. So that way, I can have them graded and give them back to you before the class is officially over. And then, so hopefully that'll give you some more time to prepare and to master the material. But I'm going to expect higher grades, especially you, Athena. You better do well on this exam.
Oh, no pressure.
Yeah, well,
Thank you.
That's the cost. That's the cost of being the spokesperson. I'm sure you do fine. Right. So then there'll be two changes for the exam, as I mentioned before. So let me just reiterate them. One, there'll be a sample exam that you should definitely take before the actual exam. So that'll give you some idea of the type of questions you can expect. Although don't hold me to the level of difficulty. I tried to make them similar, but it's not easy. And then the second change is you'll be able to go back and forth, like we discussed for the first exam. So that would make it a lot easier, I think. I'm also going to increase the timing a little bit more to 2 hours instead of 1 hour and 45. So that will also give you some time to maybe check your notes. Yep. So that's the plan. And then I think both the sample and the final should go online this week. This weekend sometime. Do you guys have classes tomorrow? No. Okay. No. So I'll make sure that they go online today. So that way, if you want to take a look at them tomorrow, you'll be able to do so. So that's the plan. But please don't forget to turn in your projects next week. And I'll send a reminder through Canvas as we get a little closer to that date. Okay, good. Now let's see. You guys have any questions for me for the project or anything left over from last time that was unclear? I'll take that as a no. All right, so let me tell you what we're going to do today. Unfortunately, or fortunately, I don't know, today's our last class. I'm a little sad because I won't see you guys after this. Well, I will if you come to the office hours, but today's our final class. So what we're going to do is we're going to finish up our work. There are a couple of things that we're left to do that we have to master. So one, we have to take a look at the remaining accounts on the shareholder equity side of the balance sheet. We started last time. We're going to continue today. So that's number one. Number two is going to be the statement of cash flow. So the statement of cash flow is something that you guys need to master because you're going to use it in your other classes. Especially, I think Suresh's class relies on the cash flows quite a bit. So I'm going to show you how to construct a statement of cash flow. And we're going to do an example together. Now, whatever we cover today is fair game on the exam, so I'll make sure I put some practice problems on my business course for the cash flow stuff and for the shareholder equity stuff, right? It's not going to be graded anymore, though, so there's no more graded homework, but if you like to take a look at them before you take the exam, that would be good. All right, so if there are no more questions, let's get started. All right, so let me share my screen with you. All right, guys, so last time we talked about J&J's balance sheet, and we started looking at the, come on. All right, all right, so I'm having technical difficulties already. Let me try again. Okay, there you go, it's moving now. So we were looking at the shareholder part, the shareholder equity part of the balance sheet. So we started talking about things like, preferred stock, common stock, and repurchases. I think that's how far we got. So let's just review quickly. Burley, hi, good morning. I like your background. Now, Burley, just remind us, what's the main difference between preferred and common stock? If you remember. If you don't, that's okay.
People who have preferred stock get dividends first.
Very good. So they get the dividends first, right? So that's the main difference. And there's some other differences too, like preferred stock doesn't vote, right? We said there's no voting rights. The other big difference is that the dividend on preferred is fixed, right, Burley? So you don't really participate in the upside. So some may argue that's just as important as getting your dividend first, right? So if you buy preferred stock, you're probably not going to make a killing the way you would if you buy common stock and you get lucky, right? So that's another big difference. Now you can also compare preferred stock to debt like bonds and notes. So Marina, what would you say is the biggest similarity between bonds and preferred stock?
Maybe their position on the totem pole in terms of who gets paid first in case of a bankruptcy.
That's good. So they both get paid before common, right? So you can say that's one similarity. They both have to get paid before common, although between the two, who gets paid first?
I think preferred.
Bonds.
No
The
bonds,
bonds,
yeah, because
the
it's debt.
bonds,
Sorry.
exactly, right? So just follow the order on the balance sheet. If you come before on the balance sheet, you get paid first, right? So just follow that order. All right, so what about another similarity other than the fact that they're being paid before common? Marina, you want to think of another one? What
Can you
else?
repeat that?
What is another similarity between bonds and preferred stock? What about
I mean,
their pay? What about
Yeah,
their
they
payment?
both pay you.
What's that?
They both pay you. It's not just like a growth, it's not just like a growth valuation, but you receive income from both periodically.
Sure, and also not only do you receive income, but it's a fixed amount, right? So
No.
you the interest and the dividend are fixed on both debt and preferred stock, right?
Not on preferred stock.
It is. The dividend on preferred is fixed. It's based off of the contract, right? So it's either stated as a percentage of par, or it's going to be stated as a dollar amount. Now, of course, there might be exceptions, but 99% of the dividend on preferred stock is going to be fixed. So that's another similarity between the two, right? So if you're going to get paid, you know exactly what you're going to get paid, right? For both debt and preferred. For common, you get whatever the board of director declares, and oftentimes they're going to increase that dividend slowly over time. It's very uncommon for dividends to get cut because it's a very bad signal to the market. But they do get increased in a stepwise fashion, right? So they start at $1, then $1.10, and they stay there, then $1.20, and then so on and so forth. All right, so what is then the biggest difference between preferred stock and debt? We said, well, they kind of look like debt, but what is their main difference between the two? Liz, do you remember? Or can you think about the main difference between the two? Like, why is preferred stock called stock rather than debt? Anybody else want to help us out?
It's a ownership in the company as opposed to just a debt that's repaid.
Well,
Due to
not really,
bankruptcy.
because your dividends are fixed for preferred. So unless it's convertible into common, then you don't really get much ownership. But that's a good guess, analyst. What else could be the main difference between the two? Why is one called debt and the other equity?
So if it goes bankrupt, you pay the debt first.
Yeah, you do get paid first for debt versus preferred, but that's similar for different types of debt as well, right, Prosenjit? You have debt maturity. I mean, the debt is also structured by seniority. So that's not enough to make it into equity rather than debt.
You don't get a lump sum payment at the end of maturity for stock.
That's true. That's true. But there's also some debt that also is structured that way, which is perpetual debt, where there's never a maturity payment, just like stock. So that's a good guess, but that's not it. What's the main distinction between the two, guys, between the debt and the preferred stock? Why would a company ever issue preferred stock instead of debt? Let me ask it this way. Maybe that'll help. What's the advantage of having the preferred stock versus the debt?
The preferred stock's not repaid.
It's perpetual, but you can issue perpetual debt too, Annalise.
It impacts the taxes, their income differently.
It does somewhat, right? But that's not it.
You have to pay back your debts, but you don't have to give out dividends.
Thank you, Burley, right? You can
Woo,
skip the
Burley.
dividend. You can skip the dividend on preferred and not go bankrupt. That's a huge thing, right? That is a huge thing. So please don't forget that the dividend on preferred could be skipped without putting you into bankruptcy. While the interest payment on debt cannot be skipped. Once you skip it, then you're going in reorganization of some type or other, because you're in violation of your debt contract, right? So that's why some companies may choose to issue, preferred stock versus debt. There's some other, of course, benefits sometimes to issue preferred stock. For example, a lot of institutional investors don't pay taxes on dividends from preferred stock. So they're tax advantageous to certain entities. But, keep that so in the back of your mind. That's not the main issue here.
But Val, even if you skip the dividend, you have to go back and pay it though, right?
That is true, but it gives you time and flexibility, Noah, right? To survive. You don't have to give your company away to the preferred shareholders, right? But with debt, even if you have a good business, you get hit with a crisis, you can't pay, somebody will just come and scoop it up. That somebody will be the bondholders. And they'll just reorganize it and run it, but then you're not the shareholder anymore. It's the bondholders that become the shareholders in that case, right? So just keep that in mind. If you're kind of worried about the risk of not being able to pay your interest, then be careful with issuing debt. You probably want to go the equity route. And preferred
Val-
equity is a good way to do it. Yeah, Annalise?
Just to piggyback off Noah's question, I thought when it was like referring to it as like cumulative preferred stock or non-cumulative, I thought it meant like you could straight out, if it was non-cumulative, skip a preferred
That's
stock
correct.
payment as long as you didn't pay the common stock.
That's correct.
So like he was saying, you have to pay it
Well,
afterwards.
he was
but
talking about the one that was cumulative.
Okay,
So the
so that there
cumulative,
is an
you have
option
to-
for you to just
Yeah,
completely skip it, not pay it in the future, as long as you're not paying the common stock at the same time,
if it's non-cumulative, yes.
if it's non-cumulative. And
Yeah.
that's
Like the homework,
defined
the
when you're
project.
buying the preferred stock.
Not to skip ahead, but the project, they don't pay, right, that we're doing?
Well, for your project, you have to figure out if they actually have preferred stock.
They don't, preferred or common. They don't.
Well, they must have common stock. Andrew, everybody must have common stock, right? Somebody has to own the
I meant
company.
they're not paying dividends.
Yeah, they may not be paying dividends. I don't want to give it away. You gotta check, right? Whether
Sorry,
they're paying.
Sorry, I was trying.
Yeah, you gotta check whether they're paying or not. And then you gotta think about, does it make sense to pay or not? So we'll talk a little bit about dividends today and see when it makes sense to pay them or not. Okay, good. So that's where we were. And then we also talked about the different shares that get reported. We talked about shares issued, shares authorized, and shares repurchased. So we said that the main number that you want to look out for is the shares outstanding. And then I showed you how to calculate it as the difference between the shares issued, which for J&J was this number right here. And then the shares repurchased, which was the shares that are sitting in the treasury, which was this number right here. Okay, so that's where we are right now. We talked about different reasons for repurchases, and I showed you the actual repurchase transaction. So we said that most companies, including J&J, like to show the total amount of shares repurchased on the balance sheet. So you can see here, the treasury stock is just that number. It shows you that they have repurchased the 487 million shares. And it also shows you the costs on average that they have paid for these shares. So it's about $38 billion. So you can divide the cost by the total number of shares and see what's the average purchase price for the treasury stock. Now, this kind of presentation is very helpful to investors like you and me, because we can kind of take a look and see the actual amount spent on repurchases. So we can judge managers based off of that information. So for example, let's see how much they paid for each share. So let's calculate it ourselves. So I'm trying to get my calculator. But I'm
Hey,
stuck.
Val, why
Yeah.
are there two numbers for shares? So it's 487 and then a
Yeah,
457.
because they're
Those
2
are the
years,
2
Liz,
years?
right? You
Okay,
see they're
okay.
2 years, so.
Yep.
So this number corresponds to this year, and then the
Got it.
487 is this one.
Thank you.
Yeah, so let's see here, the cost that they spend buying back their shares is gonna be just the total cost shown here. So let's see, cost per share, where am I? I'm right here. So the cost per share is going to be the 38,417. 0.0000000. That's what a billion looks like, right? $38 billion. So always be careful with the billions. And then the number of shares is given as an actual number. So that's 487,336,000. So if we do this math, 487,336,000. So I'm getting, so I'm getting about $78 per share, right? So they spend on average $78, $79 a share buying back this equity. And you can always judge sort of how, whether this happened to be a good investment or not by comparing it to the current stock price for J&J. So let's see if we do that, what do we get for the current price? I think it's about 150, but I'm not sure. They've been in the news a lot today. I mean, this week, of course, because of their vaccine.
It was 161.
161. Okay, so today the price is 161. So you can say that, on average, it looks like this was not a bad investment for their own shareholders because they were buying it at 78, and if they had not bought it, it would have been worth, 161 today. So that actually made their shareholders better off as well. Okay? So that's just a straightforward calculation you can make. Of course, they're not really doing it to time the market. We said they're doing it primarily to return money to their shareholders, right? Which was done instead of dividends. Now, the other format for presenting the same information is to retire the shares outright, right? So in this format, if you choose to retire the shares that you repurchase, then this account here is going to disappear. So there will be no more treasury stock account if you retire the shares. Instead, what's going to happen is you're going to go back to your common stock and additional paid-in capital, and you're going to remove any traces of the shares that you're repurchasing. So you're going to reverse the issuance transaction for those shares. Are you guys with me? So you're going to go back and say, well, imagine those shares were not issued ever, right? So you're going to reduce the number of shares issued. You're going to reduce the par value per share. I'm sorry, you're going to reduce the par value, and then you're going to also reduce the additional paid-in capital. So you're removing those shares as if they never existed. Of course, that's not going to take care of the whole amount, though, because prices might have gone up or down over time. So then any remaining balance, it ends up being recorded as a reduction to retained earnings. So that will be the other treatment. The problem with that, Microsoft, for example, does that. So let me show you the financial statements of Microsoft. So if you just go to, Yahoo has better financial statements.
Okay, Val, while you're looking that up, you said that the companies can reduce the shares. They have to reduce the shares issued, reduce the paid-in capital. And what was the third thing?
Well, there's going to be a difference, right? There's still going to be some amount remaining after they do that. So they're going to go to retain earnings with that remaining capital. And I'm going to show it to you in a second.
Okay.
All right, but let's take a look here at the balance sheet of Microsoft. So you can see here, I want to do it as reported. Well, this guy, wow, they really changed it now. They made it like in their own. They made it in their own format now, but let me see, I'm gonna go all the way to the bottom. Okay, right here. So under shareholder equity, you know, you see common stock and you see retained earnings. And then AOCI, but you don't see any treasury stock, right? And the reason why there's no treasury stock is because Microsoft retires the shares when they buy them back. It does create a problem though, because I honestly have no idea how much money they've spent on buying back their shares. I can't see it because it's not here anymore. So then you have to go back to the old statements to find out all the cash flows associated with stock buybacks. So it really makes it sort of a pain to track. So I prefer the original format, but some companies do it this way. Now, let me show you the same transaction we saw last time. We were talking about this transaction right here. I'll show you the same transaction, but this time from the point of view of a company that retires its shares. So this transaction was buying back 100 shares of its own common stock at $22 a share. And just remember that the par value for those shares was $1. So this is the par value. This is $1 par common that they're buying back. So if they're not retiring them, that was the transaction, right? Cash going down 2,200, contributed capital going down 2,200 because treasury stock is going up. Now, if this were a retirement, it would look like this. So you're gonna still remove the 2,200 from cash because, well, that's the money you spent, right? So you have to remove it. But then instead of using treasury stock, you're gonna remove $100 from common stock account. Why? Well, because it's $1 per share. So $1 times 100, this goes into common stock, right? So $100 is removed from the common stock account. It is as if these 100 shares were never issued. So right here, when they were issued, I put up $500 in this account. And now I'm gonna remove 100 of it because 100 of these shares are being retired. Does that make sense? So I'm reversing this original entry for 100 shares. That's what I'm doing. All right, so I'm gonna remove that. Then I'm gonna remove another $1,400 from additional paid-in capital. Again, I'm simply reversing the original transaction. See, the original transaction put $14 a share into this account right here. So now I'm removing the $14 a share for the 100 shares that I retired. So that gets me to 1,500. So $1 goes into common stock, $14 offsets additional paid-in capital. And I still need another $7 to make this thing balance because I'm buying them for more. I'm buying them for a higher amount than what I issued them at. So there's another $7. So this other $7 goes into retained earnings. So this is being treated as an additional distribution to shareholders, above and beyond just returning their money. So it's like I returned their money and then I gave them another $700 extra. Does that make sense? Right? So I gave back their money that they initially put in, and now I'm giving them something on top. So that something on top goes into retained earnings. Like that. So companies that follow this approach, guys, may have very low retained earnings because it's, at some point they exhaust, the amount that they sold the shares at is pretty low. And when they're buying them back, they're buying them back at a huge premium above the original issuance price. So the entry to retained earnings could be pretty big. This negative number that goes into retained earnings, that number could be very large. And
But Val, where'd the 14 come from?
the 14 came from reversing the original transaction, right? So look, in the original transaction, I put $1 a share into common stock and $14 a share in additional paid-in capital, right? So now I'm just reversing it.
Got it.
Yeah.
What's the
And is it
apex
right
level?
that par value, this is really the only impact it has, or on these accounting, on the balance sheets. It has no other real impact.
There's no meaning to it other than that, yeah.
No.
It remains as a norm, right? Because in the old days, it actually had a meaning and now it doesn't, but the norm is still there. So people are just used to seeing it that way. Nicole?
Can you also explain the $700 retained earnings? I see seven.
The $700 is the $7 per share times the 100, and I got the 7 because I need to get to 22, right?
Oh,
22 is my new cost, right, of buying back the shares.
Yeah.
So if you follow your equation, you see that's what I need to balance the left and the right side. So basically, retained earnings absorbs the difference.
Why is the additional paid in capital not 15?
Because it was only 14 when I sold the shares, Maria, right? So when I first sold the shares, $1 went into common stock, and the other 14 went into additional paid in capital, right?
Okay, thanks.
Where are you? Okay, there you are. You guys shift on my screen, so I'm talking to you here, and then you're like somewhere else. Okay, so that's where the 14 came from, right? So think of it as reversing the original issuance, right? I'm literally reversing the original issuance. And then any difference gets recorded into retained earnings. But so companies that follow this method, like Microsoft, they end up with pretty low retained earnings because every time they repurchase their shares, it is a big reduction to the retained earnings account. So then you might wonder, wow, how come their retained earnings is so low, even though they're very successful? Well, the answer usually will be they repurchase their shares and they retire them, right? That would be a good explanation for it. Another related issue to this is that if you look at a balance sheet and you don't see treasury stock, you still have to go and check to see if they're repurchases, because they might be repurchasing the shares and retiring them, right? So it's not enough to just look at the balance sheet to find out if a company is buying back its shares or not. You have to actually look further in the notes. You will definitely see repurchases in the cash flow statement though, right? So we'll talk about this today in the second half of the class.
Val, what's the point of retiring shares?
Well, the effect, you can see that the effect of the two methods on the financial statements is very similar, right? So whether you retire them or not, the end result is your equity goes down by 2,200, right? So it goes down by 2,200 here, and it goes down by 2,200 here. So it's the same, the rationale for doing this transaction is the same as the rationale of doing this transaction, which is to return money to shareholders. But why would you choose one presentation format versus the other? That's a harder question. I think companies that like to show how much they have repurchased choose this one, and this one would be for the other firms which don't want you to focus as much on that number. That's my best explanation for why you would do this. So you're not being as transparent in some sense as the company that's showing the treasury stock method.
But these two methods don't impact the shareholder differently.
They do not impact the shareholder differently, right? Now, some people may claim that, companies that choose this method here, they're definitely not planning on reissuing those shares, right? So once you retire them, you say you can be sure these shares are not coming back. But I don't like this explanation because issuing new shares is not very costly. And on top of that, many of these shares are never issued back either, because otherwise, how do we get to $38 billion, right? So you don't want to make too much of that. So I really say it's an issue of transparency, like how much you want to emphasize that number on the balance sheet.
Al, can you go over how you got those numbers again, please? Just on the lower right-hand side of the screen.
These guys right here?
Yeah.
Okay, so this is the par value per share. So $1 in par value times 100 gets removed from common stock, Marina, right? The other 14 is the same as the 14 that got included into additional paid in capital when I sold the shares, right? So see, when I originally sold the shares, I put $1 in common stock and the other 14 in additional paid in capital because I sold them at $15 a share. Right? So this 14 came from the past transaction. The two together give me the $15 that I raised, right? The 1 and the 14 is the original cost of these shares in some sense, right? This is what I sold them at, and now I'm buying them back. And the 7 is like the premium I'm paying above and beyond the original issuance price. Does that help, Marita?
Yes, thank you.
Yeah, so that's how I got to the 22. The 1, the 14, the 7, so altogether I got the 22.
But the last one, sorry to beat this, but it's the difference between the total price per share of the initial transaction, less what you're paying in the new transaction, right? So
Yeah,
it's like,
except the other way around. It's what I'm paying for the new transaction minus the original price that I sold them at.
and you multiply that just by the total number of shares. you're
Yeah,
buying.
just total number of shares, right?
Okay.
Right. Okay, so that takes care. Oh, yeah.
Sorry,
Question.
one more thing. So when you're reducing retained earned capital, you don't have to make any other adjustments to like the revenue or expenses when you do that.
Well, no, because you're not getting an expense by repurchasing your shares, right? I mean, expenses are only incurred when you provide services or products to your customers. You're not doing that here, right? So as a general rule, transactions with your own shareholders are not expenses or revenues, right? They're not, they don't affect the income statement, but that's an important point, right? There's nothing on the income statement here. You're not recognizing any gains or losses by doing this.
So Val, to be clear, if the new price per share was $30, that new premium paid would be $15?
That's correct. You got it. Right. So that's how you end up exhausting your retained earnings, Colin, right? Because these tend to be successful companies which have gone up in price tremendously. So when they start buying back their shares and retiring them, you know, most of that amount goes through retained earnings, right? Because the initial issuance price tends to be low because these are the successful companies, right? So ex post, the prices you pay for these shares is a lot higher than the issuance price. Okay, now let's talk about the other way to return dividend, to return money to shareholders, which is the
Val, one quick
old-fashioned.
question. Sorry.
Hey,
If
you
you
guys
go
like
up
this one.
ahead, that should be 1 for common stock, right? And
It is 1.
oh
It
no,
looks like a 2.
it looks like a 2.
Well, that's because I can't write, but it really should be 1. You know,
Okay,
in
thank you.
Europe, our ones look like this. Believe it or not, right? That's how people write ones in Europe. So be careful with those Europeans. They're sneaky, right? This might look like a 2, but they're really giving you a 1, right? So they're giving you a 1. That's a 1. But I'll do better. I'm not European anymore, so that's a 1 right here. There's a 1.
Thank you.
Okay, so careful with your contracts with those Europeans. Okay, so let's look at sort of the traditional way of giving money back to shareholders, which is your cash dividends. So, you know, the entry for cash dividends we already know. So just to remind you what they look like, if I pay a cash dividend, you know, I'm gonna remove the money from my cash account, and then remember it's going into retained earnings. So this is the actual entry. There's nothing new here. We've seen that before. But I do want to talk about whether you want a company to pay dividends and whether you and I as shareholders are better off if a company pays a dividend, right? Because it's an important issue. And so finance people have spent a lot of time thinking about it. And the consensus is that, you know, whether or not you pay dividends is really sort of irrelevant to shareholders. And, you know, to see that, keep in mind that every time a company pays a dividend, it pays it to everyone, right? So Ben is gonna get a dividend, Jose is gonna get a dividend, Lisa is gonna get a dividend. So it's not like only you receive the dividend. All the shareholders get a dividend. And then on top of that, the value of the company after the dividend is paid out has to go down by the value of the dividend, right? Because you're literally taking money out of the firm and giving it to shareholders. So what's happening is, Ben, Jose, and Lisa have some money in their pocket, but when they open their stock accounts, they find out that the company itself is worth less exactly by the amount of the dividend, more or less, right? So in that sense, dividends are irrelevant. They don't improve your wealth. If anything, they reduce your wealth because you have to pay taxes on those dividends. So whenever the company pays a dividend, you get to pay taxes on that, depending on your rate. And those taxes basically turn $1 of dividends into something closer to 80 cents. So when people say, "Oh, I'm very upset my company doesn't pay me dividends," it's really a silly argument, right? Unless there's some other frictions, it's not a very satisfactory argument to give, because dividends do not make you wealthier, right? So keep that in mind, that paying or not paying dividends has no effect on your wealth. It really has no effect. If anything, it reduces your wealth. So you shouldn't be too crazy about getting that dividend from the company. Now, that being said, there are situations when dividends could be helpful, right? So, for example, if the company has a lot of cash that they're sitting on and they're about to waste, it's better if they just give it back to you, right? So instead of letting managers pursue their pet projects, it's not a bad idea to say, "Well, why don't you just give it back to me? Because I have better uses for that money," right? So if the company can no longer make your normal rate of return of, say, let's say you want 10%, but they cannot find projects that make 10%, so then just give the money back, and then you can take the money and buy, Dogecoin or something crazy like that, and then make some returns. So that's one benefit to getting the dividend, is you get to spend it yourself as opposed to managers wasting it. Another thing that it does is it sort of puts some discipline into managers' minds. Like if you have a regularly scheduled dividend, you got to make sure you have some cash on hand to meet it. So then again, you're less likely to waste the resources. It gives you a little discipline, right? Because there's an upcoming payment, which is quarterly. So that may make them think twice before they take on very risky projects. So that's another benefit of it. And if you're in a very low tax rate, usually a retiree, they like the regularity of the dividends. It's very simple. It doesn't make them worry about trying to liquidate their positions. So it's sort of slow, steady money coming in. So they feel pretty happy about that. But again, that's just behavioral. It has nothing to do with economics. You and I, though, we don't have to wait for a dividend. If you ever want to get some money out of a company that doesn't pay a dividend, what can you do?
You can cash your stock in, I guess.
Yeah, you can just sell some of your shares, right? So Nicole, if you want 10% dividend from Tesla, suppose you have some shares in Tesla, right? And Tesla doesn't pay a dividend, right? And they're not going to pay a dividend anytime soon. Well, you want 10% dividend, just sell 10% of your shares, right? So there's your 10% dividend. I mean, end of story. And it's a lot more efficient that way, because when you sell 10% of your shares, you're only going to be paying taxes on your capital gains as opposed to paying taxes on the whole thing. So dividends are very easy to replicate. So, in finance, we learned that things that are very easy to replicate should not bring any value, right? If you can do it yourself, why would you pay a premium for companies that do it for you? Makes no sense, right? So you wouldn't. So basically, companies that pay and do not pay dividends, all else equal, will trade at exactly the same value. There's nothing magic about the dividends that they pay. Now, to go back to Andrew's question about Shake Shack, right? So Shake Shack, as you said, may or may not be paying a dividend, but you want to think about, would you like Shake Shack to pay a dividend, right? How do you answer that question? Well, first of all, we saw dividends are not magic. Second of all, you end up getting taxed on them. But the third issue to think about is, can you actually do better when you get the money? Can you invest it in something better than what Shake Shack is doing, And for a company that's growing very rapidly, right, and opening a lot of new locations, you don't want them to pay the dividend because they need that money for expansion, right? They're not going to sit there and waste it on pet projects. They're literally building up their, network of stores. So a company like that, I mean, they need the money. If they give you the money back, they have to just go and issue more shares. So that makes no sense. It's very costly. So companies that have very high growth will tend not to pay dividends, which explains why I say the Teslas of the world don't pay dividends, and the Shake Shacks and all these younger startup companies, they will not pay dividends for many, many years to come. Which is not to say they'll never pay anything. If you have a company whose CEO comes out and says, we'll never give you a penny, right? Well, this company will be worth nothing. It'll just be worth liquidation value, right? Because if this company ever liquidates, whether the CEO wants to give you the dividend or not, you are getting your share of that liquidation value. That's what it means to hold the common share, right? But if they come out and say, we're going to run the company for 20 years and we're going to burn it to the ground, and you get nothing in between, well, this thing has no value, right? So you're not going to pay a single penny for it if that's what they promise to do, right? So that's a good thing to keep in mind when it comes to dividends, because people get taken, they get very excited about dividends, but they're really not very excited.
Val, just when you're thinking about the differences between buying back stock and retiring stock, the key advantage, I guess, of retiring stock is no one can ever buy back those shares. So
There's no, so Annalise, it's just a presentation difference. They're both the same transactions, right? In both cases, you're buying back shares from the market. So it's just an accounting presentation choice.
So with the buyback,
They're
no one
both
else can
buyback.
ever purchase those again from the company, or like the company can sell those stocks.
They're both buybacks, Annalise, right? Whether you
Yeah.
put it in the treasury or you retire it, these are both called buybacks.
Yep.
But what I was saying is if you retire it, it's like you're sending a signal that these shares will never be going back to the market. And companies sometimes give these shares back to executives as part of the executive compensation, you see? So is that a big signal? Not really, right? Because it's not a very costly signal. So as we know from economics, for a signal to be meaningful, it has to be costly, but it's very cheap to to issue new shares, right? It's literally pieces of paper. So, it's not a big deal.
So like when they move to treasury, as opposed to straight out retiring, they're not able to sell those treasury stocks.
They could if they want to.
Okay.
And sometimes they don't usually sell them, Annalise, but what they do is they give them to their executives.
Yeah. Okay, that's what you're saying.
Because, right, they issue stock options and stock grants. So instead of printing new shares, they can give them some of those shares that they bought back. And that way they don't dilute existing shareholders as much. But again, the company that retires the shares can easily print new pieces of paper to give to the CEO. So what's the difference, right? Not big. It's not an economically meaningful difference between the two different treatments. Okay, so yeah, so the other thing you might see sometimes is some companies may give you a stock dividend, which is one of the strangest things, right? So with a stock dividend, instead of them giving you cash, they're gonna say, you know what, we like you guys as our shareholders, so we'll give you some more shares. Right, so 10% stock dividend will give you, 10% more shares relative to what you have. So let's say you have 100 shares. So you have 100 shares here, right? And the company announces a 10% stock dividend. So a 10% stock dividend, you basically multiply your shares by 10%. So there's 10 new shares that are being issued and then distributed to its shareholders. That's called a stock dividend.
Oh, Val, how is that different from like a stock split?
It's actually quite similar to stock split, Burley, except with the magnitude. Right, so stock splits tend to be bigger. They'll be like 2-for-1, 3-for-2, 4-for-1, 5-for-1, right? These things are usually less than 100%. They're very rare because they don't really make any economic sense if you think about it. Sometimes they're being done to trick existing shareholders into thinking they're getting something of value, right? I mean, suppose you're a retiree and you're waiting and waiting to get your cash dividend and it's not coming. And then you get upset that these guys are not giving you a dividend, and then you open the mail and they give you some shares. You're like, well, you know, at least I got something. But not really, you're not getting anything, right? Because those shares, everybody else got them too. So even though you got your 1 or 2 new shares, now the number of shares has gone up. So your ownership of the company is exactly the same, right? It's like taking your existing shares and cutting them up into smaller pieces. It doesn't make you any wealthier, right? And with a cash dividend, at least you're getting some cash, which you can use. Here, you're not getting anything. You're just getting more pieces of paper, right? So they're not very common.
We were just talking about you.
Who?
Allie and I.
Very nice. Okay. So
Val, one quick
yeah.
question.
Yeah.
If you do dividends in shares, you can sell the shares though, right?
Yeah, of course. You
And
can sell
then,
the-
but
yeah,
so
you can
then
sell
would
the
that
shares.
make up like the difference then or no?
No, because each share is going to be worth less, right? After the
Right,
stock
okay, so the
dividend.
air shares are worth less. So all of your
Yeah.
shares are worth less.
Yeah, they have to be because there are
Because
more
it's the
shares
same pie.
outstanding, right? So remember the price per share, it's what? It's the market value divided by shares outstanding. If you increase the shares outstanding, but you not change the market value, I mean, it has to be that the price goes down. Otherwise, Sunita, you and I should give ourselves a lot of stock dividends, right? And we'll be very wealthy. I mean, it doesn't make any sense. So it doesn't work like that. So you share, the price per share will go down and you just have more pieces of paper, sort of similar to a stock split, except that it's much smaller. So in terms of the accounting transaction, it looks quite similar to a regular cash dividend, except that the money does not get paid out. It gets put back into contributed capital. So let me show it to you. So let's say here I have, let's see, this company has 8,000 shares outstanding, right? And they're declaring a 10% stock dividend. So the way this would work is I'm going to have 8,000 shares. So I have 8,000 shares times 10. That means that there will be 800 new shares issued. So I calculate how many new shares I have to issue. And then because this is what we consider a small stock dividend, small is usually less than 25%. The regular treatment is to cost the shares using the market price. So these 800 shares are going to be cost using $16 a share. So this is the value of the stock dividend, right? It's just the price per share. So let's calculate this. So this is 16 times 800. So 800 new shares at $16 each. This will give me $12,800. So this becomes the dividend, right? So I'm gonna take my retained earnings, remove from it 12,800, just like I would do if this were a cash dividend. But notice that I'm not paying cash. So what do? You know, how do I balance this off given that no asset or liability is affected? Well, the only thing I can really do is put it right back in here, right? So that's the entry. It comes out of retained earnings and goes into contributed capital because I paid it with shares. I gave people shares. So the value of those shares is $12,800, right? So I remove it from retained earnings and put it right back into contributed capital. A very silly transaction because shareholder equity itself now doesn't change, right? It's just out of one account and into the other because you're not giving anything of value to these folks. And of course, it gets a little bit worse than that. 800 of this goes into common stock because that's the par value, and the rest of it, which is $12,000, goes into additional paid-in capital, like that. right? I'm just splitting it again based on the par value, like I always do. Anytime I issue shares, I gotta split them. Common stock, the par value goes into the common stock account, and then everything else goes into additional paid account. But it's not an economic event, right? It doesn't make you any better off. Are you guys with me here, right? So sort of don't worry about it too much, but if you ever encounter it, that's how you interpret it. You say, well, I'm not gonna get too excited about this.
And where did these stocks, since they're paying in stocks, where did the stocks come from? They're just their unissued balance?
Say that again, Jim?
You said they're paying the dividends in additional stock here, right? That's what we're looking at. Where did this actual stocks are issuing come from? If it wasn't a stock split, do they just have them unsold in reserve?
Oh, they print new shares, Jim. They'll print more certificates. Yeah, so remember, they have a lot of shares authorized, right?
Yeah.
So they're gonna just basically increase the number of shares issued.
Does this have a dilution effect on the value of the existing stocks when they do
Yeah,
this?
yeah, the value per share has to go down in proportion to the new shares issued. Which is why you're not better off as a shareholder, right? You have more shares, but each share is worth less. So you're no better off. It's easier, I guess you can say the liquidity goes up, but then if you after liquidity, you might as well do a stock split, right? As opposed to a stock dividend. So let's take a look at some stock splits instead. So stock splits are a way to, they're literally a way to increase liquidity, because after a stock split, you lower the price per share, right? So price per share goes down, and number of shares outstanding goes up by a big factor. That's what stock splits do. So a 3-for-1 stock split will replace every one of your shares with 3. So basically you get 2 more shares for every share you own. A 4-for-1, you're gonna get 3 more shares for every share you own, and then so on and so forth, okay? So if the price per share comes down and the number of shares go up, if you think that people still gonna trade as much as they did before, then, in terms of dollar volume amount, then there'll be more shares changing hands. And the more shares change hands, the more liquid this company is, right? And then there's some benefits to greater liquidity. It attracts some individual investors to it. It also ends up reducing the bid and ask spread. It makes brokers more likely to follow the company, right? Because it's easier to trade, so they can generate some trading commissions from it. So it has those benefits, which are more about trading the shares rather than the fundamentals of the firm. So that's why companies will, sometimes will split them. But they're not as popular as they used to be, right? So stock splits are kind of dying out because the share prices in the US have moved way beyond their normal range. So all the way up to about 1999 or maybe 2005, the average price per share in the US was about $30. Why? I don't know. It was just the norm. That was the price. So anytime a company's price will go to like 100 because they get successful, they would tend to split it back down to 30 because people expected share prices to be around 30. So if yours was 120, then people behave, a behavioral explanation is people may consider it too expensive, right? Even though, remember, the price per share is that's not a measure of value, but they may think it's too expensive, so they won't buy it. So managers will just split it back to 30 so they don't look strange, right? They want to be part of the norm. Nobody likes to stick out in that way. So they used to do that a lot, but then in 2004 and 5, there are a few companies that came out that said, look, we're just not going to split our shares no matter what. And we don't care about the level of the price. And those companies are very successful, right? So as those companies' prices went beyond the thousands and they didn't split, other companies like, we want to be like them, right? Because these are the cool kids in the market. So this norm around splitting your shares is dying out. That said, companies still split their shares, right? So Tesla recently split its shares. So let's see. So before they split their shares, I think they were trading at what were they trading on it? Maybe $2,000.
They were almost at 2,000,
How much?
almost at 2,000.
2,000. Okay, good. So we'll use 2,000 as an example. So they were trading $2,000 pre-split. Of course, that they had gone up from like 300 to 2,000 very quickly. And Elon Musk is very clever, right? He's very good on playing behavioral games with people. So he thought, look, if we leave the shares at 2,000, people will remember that this stock has gone up too fast, so maybe it's going to collapse, right? So he said, why don't we just split it to make it look like, it's not that expensive. So then he split it 5-to-1. So he took this and just made a 5-for-1 stock split. So for every share you had before, now you have 5 shares. And of course, the stock price went down back to 400 per share. Right. So, you are not better off or worse off because the stock split, right? Your wealth was still $2,000 if you had 1 share. But now you have 5 shares. And you can easily take 1 share and sell it, I guess, if you want. But it kind of, it really kind of pulled a veil of ignorance in front of people's eyes because it made it look like the price has not really gone up 10 times, right? Say, oh, well, it's only $400, so maybe I should buy more of it. And people did. So now it's $700 a share, right? So it's back to being $700 a share, which is pretty interesting. But so that's what happened. Now, there's no entry on the balance on the income statement or anywhere else because you're simply multiplying the shares by a factor. But you do have to adjust your financial statements because now all the per share amounts have to be adjusted. So par value has to be adjusted, number of shares authorized, number of shares issued, number of shares outstanding. All of those numbers all of them have to be adjusted. But just like a dividend doesn't do anything for you, stock splits also really don't do anything for you. They're kind of gimmicks, But in the case of Tesla, a very clever gimmick to kind of make it look like the price is more reasonable. Of course, the price is not, still very high. It's the same price as before. So my recommendation is, kind of don't spend too much time on the per share numbers, always look at maybe market caps, price to earnings, price to sales. Those numbers are not really subject to stock splits because they don't get affected by stock splits. So, after the stock splits, all of these things remain the same. So therefore, no big deal. Right now, if you never split your shares, I think we've said that before, but if you never split your shares, you end up with a situation like Berkshire Hathaway. So, Warren Buffett is, of course, ahead of his time in many ways. So one thing he said when he founded Berkshire in '69, he didn't found it, he bought it out. He said, look, we're never going to split our shares because that's just stupid, right? He's like, who cares? If I split my shares, I just keep attracting these individual investors who don't know anything about investing. So then they're going to run at the first sign of trouble, right? So he said, instead, I want people to stick with the firm. I don't care about liquidity. And, so when you do that, this is the result, right? So this is when you don't split your shares, see? So this was never split ever since 1969. So now it's $409,000 per share. Of course, this makes it kind of hard to buy, right? I don't think the people on Reddit will be buying, Berkshire because it's $409,000.
Well, what's Berkshire B? That's A, there's B.
Yeah, so Berkshire B is like, it was created at a later stage to try to avoid others from buying the A shares and splitting them and then charging people commission for it. So the baby Berkshire is 1/3000th of the A share. So you can actually buy, a baby B share. But that was created later because people, what they'll do is, I'll open a mutual fund, right? I'll load it up with Berkshire A, and then I'll sell you shares in my mutual fund and charge you 50 basis point fee. So, you know, Buffett was like, hey, what are you doing, right? You're making money off of nothing. So he just created the baby shares for people that want to participate. But, you know, he holds these shares, the A shares. So the long-term shareholders own these shares. And so just to give you a perspective, you know, if I go all the way max, this only goes back to 1984 or so. And so you can see 1984, this thing was $1,500. But if you go all the way back to 69, that was $10 a share. $10 a share, right? So it's up 40,000 times, right, since then. Of course, it's been 50 years, but not bad, right? 40,000 times. So if you put like $1,000, well, you know, the rest is history. So I wish you guys find companies like these and just hold them for 50 years. So one, you have to find it. Two, you have to hold it, right? It's not easy to hold when this thing keeps going up like that. All right, but enough dreaming. All right, so that's for the stock splits. Now, okay, so we have that. We covered. So let's just recap the transactions. We have stock issuances, right? We have stock repurchases. We have cash dividends, stock dividends, and stock splits. So these are the main things that end up affecting the number of shares that the company issues.
Val,
Let's take, yeah,
quick question
Colin?
on stock dividends.
Yep.
Why are we reflecting the 10% less than 25% stock dividends?
Oh, I'm saying that this is called a small stock dividend, call it, right? So anything less than 25% is considered small. Who considers it? US GAAP, right? So they had to kind of draw a line between what they consider small and a large dividend, because the treatment for a large dividend is a little different, where instead of accounting for it using the market price per share, you record everything at par. So that's the only difference. So if this was like a 50% stock dividend, I wouldn't use the $16 per share. I'll just record everything at par value. Right? That's really, I mean, again, it's not really a meaningful difference, but it's just the rule. So I didn't want to bother you with it because these transactions are dying out. So you're very unlikely to see it. But in the book, they show you a large dividend as well. All right, so let's take a short break, 10 minutes, and we'll come back and talk about executive compensation, because that also affects your shareholder equity. All right, guys, let's come on back. Or maybe it hasn't been 10 minutes yet. I don't know. So did anybody buy Dogecoin? Steven, did you get Dogecoin?
I have a little bit, not a lot, not enough.
Nice. Not enough to retire, huh? You know how Dogecoin makes me feel? The same way horses felt when the cars got invented. You know, in complete disbelief.
You can only trade it. You can't buy and hold it.
You can buy and hold it? Why not?
I mean, I guess you can now, but
Buying crypto is like investing in Enron.
Yeah. I'm at a loss. I feel like a dinosaur, you know. And so Stephen, you know, I have these students from the old semester, right? So I always like talk a little bit about Bitcoin, a little bit about crypto. And you know, my usual take is, you know, I really don't know what's going on. So because they kept asking me, should I buy it? I'm like, I don't know. So now they email me, it's like, I told you it's gonna be great. So I say, what can I say? You know, my knowledge is useless in this new world. It's amazing. It's absolutely incredible to see. It's making us obsolete. That's how I feel. Every time I look at the crypto screen, that's how I feel. Okay, guys, let's come on back. I think it has been 10 minutes now. All right, there you go. A few more people. Maybe I get a few more. Yep, Robert's on, Nicole's on. Okay,
Yeah.
so let's talk a little bit about executive compensation. So why are we talking about it here? Well, because part of executive compensation, as you saw in your project, is going to be, is going to be done using stock. So whenever it's being done with stock, that means that there will be some transactions that affect the balance sheet and also the income statement. So the two most popular ways to compensate managers other than cash is to give them stock or stock options. So giving them stock is pretty straightforward, where I literally just give them shares of stock, and then I usually put a vesting period on it. Anybody know what a vesting period is? You probably have it in your own stock grants. What is it, Jim?
It's essentially a period of time that you have to hold it, or at least be with the company that gave it to you before you can keep it at full value
Right, very
permanently.
good. So yeah, companies, when they give you stock, they don't want you to just take the shares and kind of quit, go get another job. So they say, look, you know, we'll give you the stock grant, but it's going to vest over 4 years. So 4 years is a very typical vesting period, either 4 or 3. So 4 years would mean that every year, a quarter of that grant becomes yours, meaning you can do whatever you want with those shares. And it works the same way with stock options, right? So with stock options, it could vest anywhere between 2, 3, or 4, 5 years. Sometimes you can see, which means that the options only become yours gradually over time. So that's there, one, to make you think about long term. So when you make a decision, that forces you to consider the implication of that decision longer term. And 2, because they want you to stay with the company, you know, for that period, as opposed to just taking the money and leaving. Now, so stocks, actually, let's first do the stock one. So whenever the company gives manager stock, the entry for that is pretty straightforward. I actually don't have one for stock. I only have one for options. So let me just come up with an example for us. Okay, so I'll just bear with me for 1 second. I'm going to open it up in Excel. So I'll show you how we're going to account for stock grants. Now, stock grants are becoming more and more popular. They were popular, then they weren't popular, and then now becoming popular again. And that has to do with the incentives that it gives managers. We'll talk briefly about that as well. Okay, so this is my template here. This is too big though, so I make it a little smaller. By the way, why do we want to compensate managers with stock and stock options? What's the main benefit of doing so?
The retainment of the employees.
Say that again, Nicole?
One thing I think, like, to retain employees, because I mean, you're offered the stock, but it doesn't vest for 3 years. So in order to increase.
Oh, okay, so yeah, so that's a way to tie them into the firm, all right, what else? What's other benefits than to give them this versus cash? I mean, I can always give them cash, right? So why am I giving them options instead?
Incentivizes their performance is tied to performance of the company, the firm over time.
Yeah, it's a way basically to
Mm.
reduce agency costs, right? We talked about agency costs very early on in the class, where, you know, these are professional managers, they're not shareholders usually. So they will take decisions that are best for them. So by giving them, you know, stock and options, we want to make them shareholders. We want them to think like a shareholder would, so they don't destroy value, which sometimes they might, right? So we want to give them, when we give them shares, we say we want you to think the same way a shareholder would think, and be careful and try to increase the share price, because that's what shareholders worry about, right? Stock options do the same thing, but I'll explain them in a second. All right, so let's just first look at a stock grant. So sticking with our Tesla example, let's say that you know, Tesla grants some options to Musk, and they have, right? So they give them a lot of shares and a lot of options, but this will be like a typical grant. So Tesla grants the CEO 100,000 shares, okay, of stock, vesting over 5 years on a prorated basis, right? So this will be a typical contract to the CEO. And this is not done, you know, every year necessarily, but it's certainly done when you hire a CEO. So as part of the contract, they get some share grant. So how do we account for it? Well, the first thing we got to figure out is what is the value of this grant, right? So to value a grant, we need the fair value of the shares. Now, one benefit of having publicly traded shares is just very easy to figure out what is the fair value of these shares. The fair value is whatever the market says they are. So I think the last price for Tesla is what, around 700, right? It does go up and down like a yo-yo quite a bit, but I think the last one is about $700. Well, let me make all of this big so you guys can read it. Okay, so current stock price per share is $700, like that. So the value of this grant is 100,000 times 700. So, whoa, that is a lot of money. Okay, so let's put it in money terms. I gotta make it bigger. Oh, I gotta make it bigger yet. Oh, here we go. So $70 million. So this grant is worth $70 million. Are you guys with me? Why it's worth this much? Because the company, if they didn't give it to Musk, they could have taken the shares and sold them to the public, right? And they would have gotten $70 million for it. So when they give the shares to Musk, that's the fair value of this grant. So
Sorry, Val, is that locked in? So say the shares drop to like 450, or is it still worth $70 million?
Well, no, then the value of this grant will absolutely fluctuate, right? Together with the shares.
Okay.
But when you account for it, you account for it as of the date of the grant. Because right now, that's the fair value, right? So that number will basically get locked in as of the date of the grant for accounting purposes, right? Now, for incentive purposes, of course, Musk's value will fluctuate as the share price goes up and down. All right, so this is the value of the grant. Now, sometimes companies will have you believe that giving people shares is free because they're not giving any assets, right? Do not be fooled by that, because as they give shares, they're diluting the interest of everybody else, right? So the more shares you give to your CEOs, the less the interest of remaining shareholders in the company is. So this is not free, and it's very easy to see what the fair value is. It's just the number of shares times the stock price. Now this vests over 5 years. So I'm going to have to figure out what is the expense per year for having this grant. I don't want to recognize the whole $70 million up front because the grant doesn't vest at once. In other words, I'm hoping that Musk will work harder for 5 years because of this grant. It's not a 1-year effect. So I'm gonna take the grant, I'm gonna spread it over 5 years, similar to the way we calculate straight line depreciation, right? So per year, value of the grant is gonna be just the $70 million divided by 5. So $14 million is gonna be my cost per year. So the way I'm gonna record it is I'm gonna put the $14 million as an expense. So $14 million gets recorded as an expense. $14 million is here and here, right? Like that. And then to balance it off, because I'm not giving assets or incurring liabilities, I'm gonna record this as additional capital. So this is additional paid in capital of $14 million associated with this grant. So this is the entry for it. So I'm gonna have my expense, like I usually do for compensation, but instead of reducing assets, when I pay them with cash, I am increasing contributed capital because I'm paying them with equity. Right, so that's sort of pretty straightforward the way I do it, right? It makes sense, correct? You guys with me? Right, so I'll do this for 5 years. And as Noah said, the price per share may change, but I lock it in at that original consideration because that's when the shares were given. Right, I'm going to use that original price for every year. So basically, I'm going to have 5 years of this entry, same entry every year for 5 years. Jim?
So obviously, keep it locking at the same price. Could be good 5 years from now, assuming the stock price went up. What if your company's stock price just tanked and fell off a cliff? How does that affect their overall balance sheet?
It wouldn't affect the balance sheet of the company at all for this transaction, because we've given the shares to Musk, right? So it's going to affect Musk's balance sheet. It's his risk, not ours, right? So we've given them. So we only consider the value of the shares as of the grant date. Yeah. But I want you to recognize that this is not a free transaction for shareholders, right? This takes a lot of their equity interest away. So the more shares we give to executives, the less wealth is left for shareholders, right? So this is not a free transaction. All right, so this is becoming sort of more and more popular to just give them straight out shares. But the other way to do it is we can also give them stock options. So stock options work very similarly for accounting purposes, but they have very different payouts than stock does, right? So you may or may not be familiar with the way stock options work, but let me just give you like a quick crash course into stock options. So these stock options are very long term. So the way the company will do it is they're going to set up a stock option which is going to expire in 7 years. So let's set up here some stock options for Elon Musk. So this will be, a stock option on Tesla that expires in 7 years. And that will become clear in a second what this expiration have to do with anything, right? So these options, the word option comes from the fact that these instruments may or may not be exercised. So the CEO has the right, but not the obligation, to exercise the options. And if she chooses to exercise, well, in this case, it's him because it's Elon Musk. So if Musk decides to exercise the options, the way it would work is, to exercise the option, CEO pays Tesla a pre-specified price, specified price per share, called the strike price. Right, so each option comes with a strike price. So if the CEO decides to exercise the options, they get the shares at that promised price. All right, so let me make it more concrete. So if Tesla was to give Musk options today, they're gonna pick a strike price of 700. So the strike or the exercise price that the company usually picks is the same as the current stock price. So this is same as current stock price. So they give them options to buy the shares at $700. Okay, that's how it's usually stated. Are you guys with me? So if you haven't seen these, it might seem a bit complex, right? But an option is just the right to buy the shares at a pre-specified price. And when companies grant CEOs options, the pre-specified price tends to be the current price. And now think about it.
And that's locked in, Val? That's
Yeah,
locked.
Colin?
I said, and that's locked in?
That's locked in. That's locked in for the life of the options. Now, the expiration date, right? The 7 years is how long Musk has to exercise these options. So he can exercise them between now and 7 years from now. They don't have to exercise them today. And these also have vesting periods. So they would vest usually over 4 years, but you have 7 years to take advantage of that right. Are you guys with me? So 7 years is how long you have to exercise your options. So once you give them the options at $700 a share, their incentive is what? They have to work hard to get the price per share to go above 700, right? Because otherwise they don't make money. You will not make a single penny on these options if the price does not go above 700. Because why would you ever exercise an option at 700 if the stock price is at 690? So I'll give you a few hypotheticals here. So let's take a look at different values for Tesla shares. So you can see how much money you make per option. So let's say, Tesla shares are $500 a share. So then the profit of exercising these options will be negative 200 if you exercise them, right? You have to buy it at 700, but you can only sell it for 500. Well, you lose $200 a share. So that's really dumb, right? So you're never going to do that. You don't have to, right? It's an option. So you say, if it's $500 a share, my profit is zero. If it's $600 a share, same logic, profit is zero. Why would you do that, right? You're not going to buy it for 700 to sell it at 600. $6.99, the profit is zero, right? Again, you don't make any money. But if it goes above 700, then you start making some money. So if it's like 750, then your profit is $50 a share. If it's, 1,000, then your profit is $300 a share. And, if Kathy Wood from ARK Investment is right, and this thing is $3,000 a share in 5 years, then you end up with $2,300 profit per share. Are you guys?
How does it work if a stock splits? Does the amount go up or does it stay the same?
They're gonna adjust the strike price for a stock split, Brent, right? So if the stock splits 10-1, they're gonna drop the strike price to 7. Are you with me? Right? So they're gonna reprice the stock options basically on that date.
Does that also work for like the grant?
The grant doesn't change. Oh, you mean for the remain? Well, you already have the shares in your account. You just can't sell them. So those shares will split automatically if you give them the stock grant. You see what I'm saying? Because these are your shares. You just can't sell. But they will split for you, right? So the stock split, they're going to adjust the price, the strike price per share. But the grants, you don't have to do anything. They automatically get adjusted. All right, so does everybody understand how the payoffs work? Right, so it's very asymmetric. So the payoffs, if you think about the actual payoffs for stock options, they, you make nothing. So let's say this is the time. I mean, this is sort of the price per share, and this is your profit. Until you hit $700 a share, you make nothing. There's no profit at all. So it's not actually here. It's zero. So it's right here. Put a different pen here. Right, so up to 700, there's no profit. And then when you get above 700, then you start making, a lot of profit. So it's It's like all or nothing, right? You either make a lot of money with options or you make nothing. And you can definitely make a lot of money if you have, stock options and the price goes up. But if it doesn't go above 700, then you make nothing. So managers in this case have very strange incentives, right? If they fail, they get zero. They don't get punished for failure, right? But they get rewarded very highly for success. So faced with these asymmetric incentives, their best bet is to take a lot of risk, right? Because they don't get punished for failure, really. But they have to get the price above 700. So they end up taking a lot of risk to try to get, in this area right here. And so it basically gives them similar incentives to stock just on steroids. Right. So the idea initially was that if we give them stock options, they're going to work even harder to make the stock price go up. But it turns out that working harder sometimes means working dishonestly, right? Because you can increase the stock price the right way, or you can increase the stock price the wrong way. The wrong way being you start playing games with your numbers, right? And there have been plenty of cases where CEOs have been accused of manipulating the numbers just to get to these payouts at the end of this rainbow. So because it gives them these huge incentives to take risk, these kind of contracts are kind of on the decline. You see a lot more just giving them shares. Because with shares, it's quite different, right? With shares, they always make some money. And if the stock price goes down, they still make some money, just less. And if it goes up, they make more. So shares at least make them think a little bit more like a shareholder. This is like a casino, right? If you can get it above 700, you become rich. If you get it below 700, somebody else gets poor, right? Not bad. So people don't like, companies have moved away from some of these incentives. Now, to continue my example with Tesla, though, I have to figure out at the time of the grant, what is this thing worth, right? So I'm going to give them these options. And remember, I want to give them compensation worth $70,000. So that's my plan. I still want to match the same number. But the question is, how many options do I get to give them with the same $70 million? So I have to go and figure out what is the fair value of each option. Now, you can imagine that right now, the option will not be exercised because, $700 option, $700 price, no profit. But this thing has a lot of value because you don't have to exercise it today. You can wait 7 years until you exercise. So the probability that Tesla ends up above 700 in 7 years is pretty good, right? So this thing has a lot of value. So how do you figure out the value of options? Well, that's a whole class that you guys will probably take later on. But this is the Black-Scholes there's a Black-Scholes model for valuing these stock options, which basically takes into account the path of the price, etc. So we're not gonna do this model in the class, but I'll just tell you, let's say what the options are worth. To get some idea, though, we can look at actually traded options. So you probably can't see it, it's kind of small, but these are the actual traded options for Tesla. They're not the same as the options we're looking at because these only go up to 2023. So the longest expiration date here is about 3 years, actually 2 years, because we're already 21. So 2 years is usually the max of the options that are sold in the market. These options, guys, have nothing to do with the company. These are options that are being bought and sold by investors. So it's like side bets on the company that people trade, right? But you can get some idea of the pricing of these options to see how much they're worth. So, for example, the 2023 $700 strike, which is right here, right? So see the Tesla call March 23 $700 strike is right now being traded at $300 a share or so, right? So this thing is worth quite a lot of money. Why? Because the market apparently thinks there's a very good possibility that in 2 years, the value of the shares is even higher than $700. So it's about $300 a share. So we can take that as an estimate for what our options will be worth. Of course, our options will be worth more than that because they don't expire in 2 years, they expire in 7 years. So if you make adjustment for that, you're probably looking at $350 per option or more. So fair value per option is gonna be, let's say, 350. I mean, I don't know exactly what it is, but companies will tell you in their annual report what it is. So this is 350. So that means, let's see, how many options can I grant my CEO? So I have $770 million value of my grant divided by 350. So I can give him 200,000 options, right? With the same value. So you can see that when I give them options, I can give them more underlying interest. You guys see that? Because I'm not giving them the shares, I'm giving them options on the shares. So that way their payoffs are even larger if they succeed, right? So this 200,000, so 200,000 options. So let's see what the total profit will be on these options. So if I make zero, I mean, if I don't exercise them, I don't really make or lose any money. So that's easy. So that's still no profit. All the way up to $700, there's no profit. But then if I exercise at 750, I make $10 million. If I exercise at 1,000, I make $60 million. And then if I exercise at 3,000, I end up with $500 million. You guys see that?
What did you multiply by? I think I must have.
I multiply it by the number of options granted, right? Which is that $200,000. So this is number of options granted. So this gives you an idea of the profit with options. Now let's compare this to the profit with shares, which we gave them too. So shares worth. All right, so I gave them.
Everyone's supposed to be in person, but they canceled the year in person. It's virtual. Which I.
Jose, you're off mute.
I fixed it. Right, so this is the total profit with options. And then in terms of the shares, how much they're worth, let's see, how many shares did we give? We gave him 100,000 shares. So the worth of the shares will be quite different, right? So the shares will be worth 500 times 100,000. So see, the shares have a value regardless of whether you meet that or not. So this will be 500. Like that. So these are the payoffs with your shares. So you can see that, with options, if you end up hitting it way out of the ballpark, you end up very wealthy, right? Now, Tesla is not, the Tesla options are very expensive because people are clearly very optimistic that this will work out. But, for companies that are not so speculative, you can give a lot more options than shares with the same amount of money. And then if the manager ends up succeeding or they get lucky, then they can walk away with very, very large payoffs. All right. In fact, they could get so large that it kind of makes no sense eventually, right? So think, for example, some of the CEOs that retired in the around 2010, either 2000 or 2010. So Steve Ballmer, you guys know that guy? What did he used to do?
One of the founders of Microsoft.
Microsoft, right?
Microsoft, right. So what did he do after he retired?
He bought
Basketball team.
He bought a basketball team. How
yeah,
did he do
bought-
that?
I forgot who he bought.
Yeah, but how did he do that? How did he make so much money? Well, he was given a lot of stock options, right? And those stock options turn into billions and billions of dollars. Now, so I think he retired with something like he made like $3 or $4 billion running Microsoft.
He bought the Clippers for $2 billion.
There you go. So 2 billion, right? So, I mean, is that a reasonable compensation for a CEO? Probably not. So ex ante, when you hire them, you probably would think that $2 billion is excessive, right? But because you gave them options and they happen to get lucky or good, whatever, options went up in value, they did walk away with a huge payout. So options can do that to you, right? Because when you're granting them, you're like, oh, well, I don't think it's going to go up to whatever it is today. Microsoft is at $300 a share. So you don't think that this payout will happen, but it could happen. And when it does, you're basically giving a big chunk of the company away to that one person. So it's very costly for shareholders, basically. That's what I'm telling you. So that's another reason why companies have moved away from giving these stock options, because they much rather understand exactly the value that they're giving out here, as opposed to playing this lottery with the options. Because sometimes you end up compensating managers way above and beyond what you plan to do. Another example is Jack Welch. You guys remember Jack Welch? What did he do? Sunita's like, I've never even heard of this guy.
He's GM. He took over GM.
Not GM, not GM.
General Electric, sorry.
There you go. You got the G right. So he was actually the CEO of GE for many years. And he presided over a big disaster. However, the disaster didn't happen until after he left the company. So he was there for like 15 years or so, and he kept getting stock options. And at that time, GE stock was doing very well. So it kept going up, and his options were worth billions of dollars. So I think he retired a billionaire from GE. And after that, GE has gone into huge trouble. So it went from like $30 a share all the way down to $5. And even now it's about 12. Okay. So he really did a lot of bad things in our company, because he was doing a lot of acquisitions, and a lot of them didn't make much sense. But he retired a billionaire. Why? Stock options. Can you get that back? No, you can't get it back. So after he retired, he wrote a book from the gut. I don't know if you guys have heard about this book. And then he went to teach at Harvard, telling people how to become very successful managers. But then it turns out he ran the company into the ground. So that's what these stock options do sometimes, right? So when somebody claims they're so good, be careful. They're not necessarily very good. Anyway, long story short, now, how do we actually account for the options? So let's take a look at an option example. So I'm going to go back here to my notes so I can put it nicely. So let's take a look at a stock option grant. So with stock options, again, you want to record them at fair value, whatever the value of the options is. So let's read this. So the company grants options to purchase 8,000 shares to senior management as part of their bonus plan. The options are granted at a $20 strike and vest over 4 years. So the $20 is whatever they can sell it at, right? Whatever they can buy it at. And time to maturity is 7 years, and the value of the options is 12. So what you need here for our purposes, you have to keep an eye on the number of options granted, the fair value of the option, and the strike price. The 7 years is not relevant to us because that's already baked into the $12 value here. But we do need to keep an eye on the vesting period, which again is 4 years. All right, so let's see, how would we account for it? So I'm going to take 8,000 options at $12 each. I don't use the strike price. I use the fair value. That's the value of the grant. So this would be, let's see, 8 times 12,000. I get $96,000 of fair value for the whole grant. And this vests over 4 years. So I'm going to divide this by 4. And that would give me $24,000 per year expense. So the entry here is the same as for stock. I'm going to record $24,000 of expenses. I'm going to reduce my net income by 24,000. It's going to reduce retained earnings by 24,000, and I'm giving them options. That's another paid-in capital account for $24,000 for the options. Same thing as I did with shares, right? Nothing new. And I'm gonna do this for 4 years. 1, 2, 3, 4. Every year the same entry. 1, 2, 3, 4. Okay. And then I'm also gonna keep an eye on whether they exercise these options or not. Because if they exercise the options, they're gonna be giving me some cash. So I have to record that if and when they ever exercise it. So let's say here, after the 5th year, they exercise the options. So what that means is they're gonna give me the strike price and I'm gonna give them the shares. So 8,000 shares at $20 strike price, the company is gonna get $160,000. Well, wait, is that true? 8,000 times 20. Yep, the company is gonna get $160,000 in cash. So I'm gonna book this as 100. This I'm doing it from the company's point of view. So company gets $160,000 in cash. And to balance it off, remember they give them shares, so they record another $160,000 in contributed capital. So that's how this, the exercise of stock options is treated as an issuance of new shares. To the company, it doesn't matter what the current stock price is. That matters to the CEO. Right? The company just cares about the fact that they're getting $20 a share and they're giving the shares to the CEO.
So the fact that, let's say the actual stock price was like $27.
It doesn't matter.
It doesn't matter. We just are using the strike price.
Yeah,
But
because that's the
person
cash.
who's exercising the option loves that it's 27,000.
Yeah. Even if it's 100, we still keep the $20 because that's all we get, right? And the fact that the stock price might have gone to 100 is already taken into account at the fair value at the time of the issuance, right? So this $12 fair value, Noah, takes into account all possible paths of the stock price. So it's being recorded in expectation, right? So we expected up front that this is going to cost us $12 above and beyond the $20 that we got, right? And it's just a probabilistic assessment of what might happen. So the Black-Scholes formula gives you this value right here, and that's based off of all possible paths the stock may take between now and 7 years from now. The guys actually won the Nobel Prize for that formula, so it's not a simple thing that they did. They figured out how to solve for it.
So the actual market price at the time of issuing the stock options was probably lower than the $12.
No, it was 20.
It was 20. Oh, I thought that's the price that they could buy it for.
Yeah, but as I told you, we usually set it equal to the current market price.
Okay.
Because we want them to work to make the price higher, right? I don't want to give it at 10 because then I'm giving them free money. It's already 20. Why would I give it to them at 10? So I give it to them at the same price as the current price. So hopefully they work to make it higher. Right?
So the $12 is what they'll likely, what the stock option holder will
$12 is the
likely-
the $12 is the expected wealth we're giving them.
Okay, so they're calculating the price to be $32 at the end of 4 years.
Eventually, yes, you can think of it that way, analysts, yeah. But this number, right, the Black-Scholes, this is the expected value, right? I don't know what the true value will be because I can't see the future. But based on what I know today, right, I can figure out the expected value of that stock option, and that's $12 a share. Now, after 4 years, it might turn out to be 100, right? It might turn out to be nothing. I don't know. But as I'm giving them that option, that's the expectation, $12 of value.
Why, when the options are executed, why is the company recording an increase in cash and contributed capital?
Because Jim, exercising the options requires the CEO to give the company $20 a share. That's what the strike price is, right?
Okay.
And then the company then hands over the shares.
Okay, so the CEO exercising the option only gets the amount above the strike
Yes,
price.
yes, which is different than shares, right? With shares, they get the shares and then they're worth whatever they're worth, right?
So if you exercise an option and it's below the strike price, then does the CEO have to give the company additional money?
Well, but you'll never exercise below,
Right.
right? See my
Well, you mean I
graph.
won't because it's stupid, or,
Well, why would you? You're losing
Yeah.
money if you're a CEO, right?
well, say I'm stupid like that. What would happen if I did
Well,
it?
you probably won't be CEO if you're stupid.
Can it be done? I meant, what would
I
the transaction look like?
I don't know. I don't think anybody's ever done that.
Oh.
You can try it. I hope you become CEO just to mess with them, right? Exercise them when they're out of the money. I mean, you could, right? I mean, there's nothing preventing you from doing that. But I have no idea how the entry would look. I haven't
So
seen-
Val, if they don't exercise the stock option, does that go back into the accounting or does it just stay a
No,
cost?
you don't. If they don't exercise, you don't record anything else because you had recorded an expectation, Brent, right? So the expected value was 12. The fact that it turned out to be nothing, well, what are you going to do?
So then you get the 96,000 back.
Yeah, but you don't record that back. Because that's the value given in expectation. You leave your accounts alone, even if the options expire worthless.
So it just disappears. You made the $96,000.
No, I mean, on your books, it's still gonna be there, that 96,000. It's not gonna disappear. But you're right, it does create a problem, right? Because sometimes these options are exercised and sometimes they're not. And the logic of treating them this way is that on average, you are right that it was worth $12, right? So if you accumulate across many different stock option grants, you probably get it about right. So we're going for an average effect, right? So each one of the grants might be off, but if you sum across all the grants, you should be able to get close to the actual number. Make sense?
Val, the only question I have is,
You only
we
have
are,
one?
because we're not debiting cash, well, because we're crediting cash and contributed capital.
No, I'm debiting cash here, right?
Oh, okay, so you're debiting cash.
Yeah, cash is going up and so is contributed capital.
Okay.
Both of these accounts are going up because the CEO gives me money, so that's money coming in. And I give him shares, $160,000 worth of shares, right?
I guess the reality is that this is more theoretical, right? Because it's not that the CEO is usually giving money. It's like the.
No, it's not theoretical. If the CEO wants to exercise her options, she has to give us $20 a share.
Well, I'm thinking of like, for example, I have options with J&J. If I choose to exercise them, I don't physically give them money. I get the.
Well, you do. They just withhold it from your final amount.
Right, exactly. Yeah.
So when you exercise your options, they exercise them for you, right? So what happens is they take the shares, they sell them in the market, then they take the strike price, keep that money, and they give you the difference, Nicole.
Yeah.
Of
Okay.
course, they also keep some taxes too. Right? There's some tax implications when you exercise your options as well. But you are really part of that. You are giving them the $20 a share, right? You just do it from the proceeds as opposed to actually writing them a check. You see what I'm saying? But the end result is still the same. Now, if you're offered options, do you want to take it? Yeah, it's like a nice gamble you should take. If you're given the options, then maybe you want to accept that because that you can become very wealthy with options.
Now, what about restricted stock plans?
Yeah, well, the restricted ones are usually related to some sort of goals, right, that the company sets for you. So
Like a bonus, yeah.
Yeah, so those also, I mean, they will be accounted very similarly to this, except that on top of what we did, you have to figure out how likely you are to be meeting your goal. Right, so the expense will be adjusted for the likelihood of meeting the goal, just a little bit more complicated than that, but the principle is the same. Right. Yeah, so they're these
With
restricted.
to Andy's question, with the restricted stocks, it's not stock options, it's actual stocks.
Well, you can also have restricted stock options. I mean, I haven't seen those as often, but these are just legal contracts. So if you want to create a legal contract, you could.
And companies can give them at no cost. I mean, if almost like a bonus.
Well, they give them at no cost to you, but there's a cost to shareholders.
Right. Sorry. Yeah.
Yeah, absolutely. They give you shares, right? Or they can give you units or rights where you only make the difference above and beyond a certain amount. So there are many ways to write it. And the note, I'm sure you guys saw the Shake Shack note on compensation. It's all gonna be detailed there, what kind of things they're giving their employees. So they're gonna go through it in some detail, saying, okay, we give them restricted stock, we give them units, we give them shares, we give them options. This is how much the options are worth, this is how many shares we've granted. This is the vesting period. So read that carefully because all those shares are coming at you in the future when they vest. So as a shareholder, you want to know exactly how many shares are out there that can be granted. All right, so this is it for stock options. Long story, right? But it's important because a lot of the change in shareholder equity comes from these kind of plans. These days, companies continue to grant a lot of shares, not so many options, but shares. And those shares dilute existing shareholders. So you want to understand very well how do they pay their executives. It also gives you an idea about the incentives of the executives. Final thing I want to say, right? Suppose you have two companies which are identical in all respects, except that one set of the executives is paid with cash and the other set of the executives are paid with stock primarily. Which one would you pick to invest in?
The stock one.
Why, Marina? Why the stock one?
Because the people running the company are personally invested, like with their own money.
Very good. Exactly. Right. So if nothing else, check to see how much skin in the game do managers have. I would never buy, well, I don't want to say never, but I would tend not to invest in stocks or any other venture for that matter, where the managers have no skin in the game, right? So if somebody offers you an investment, just ask them how much of your own money is in that investment. And if they don't say like, all my money is in that investment, then walk away, right? You want all of their money to be in that investment if you could, right? Because then they really care. If they're just running your money, then, well, that's a lot easier, right? Then you can buy Dogecoin and Bitcoin with that, and that's okay, right? But are they putting their own money in it? That tells you a lot. That really tells you a lot. So keep an eye on that disclosure. It's very important. All right, let's see. What else do I have for you guys? So we did this. Oh yeah, I want to touch upon two other accounts which are sort of left that we didn't discuss. So one is the non-controlling interest account. I'm trying to figure out which company had a non-controlling interest account. So just bear with me for 1 second. I want to show you what this account looks like. And I think I have a good example for that. Let's see which company has that account. Merck. Let's take a look at Merck. J&J doesn't have a non-controlling interest account, but Merck might. So let me just go quickly to their balance sheet. All right, so this is the balance sheet of Merck. Ah, they do, thank God. Okay, so this is the balance sheet of Merck right here. So all the way on the bottom on the shareholder equity, they have this account right here called non-controlling interest. And this is actually quite common. A lot of companies have an account like that. So we just want to briefly mention what it is. So you can see when they do their accounting, they do the Merck shareholder equity, then they total the Merck shareholder equity, but then they have some other non-controlling interest which gives you a different number for total equity than whatever the Merck shareholder equity number is. So what is this $94 million doing here? Okay, so let me try to explain this briefly. So the way this works is that to understand the 94, we have to go back and look at this language and realize that these are consolidated statements, right? So what you see here is not just Merck, but also remember all the other entities that Merck controls. So these are all the subsidiaries. That's why it says Merck Co. and subsidiaries. Same thing for Shake Shack, right? They have Shake Shack parent company and all the other subsidiaries that they own. So when I do the accounting for the consolidated statements, I include all the subsidiaries at 100%. So 100% of the assets of the subsidiaries are here. And 100% of the leverage or the debt of the subsidiaries are here too, right? So I basically take all of it and put it into one statement, 100% of everything. But then it turns out that some of the subsidiaries are not fully owned. So what does that mean? Well, you can own only 60% of the subsidiary. So Merck owns 60% of a subsidiary. They control it, but they don't fully own it. Right? Are you guys with me? So this happens all the time, right? So companies don't have to own 100% of a subsidiary to consolidate it. They just have to own 50% of it. So that creates a problem because I've included all the assets of the subsidiaries here. So that these include all the assets of the subsidiaries. This here includes all the liabilities of the subsidiaries, right? So all of these are all the liabilities of the subsidiaries, but I don't own all the equity. So I got to make an adjustment for the fact that some of these assets and liabilities I don't own. They belong to the guys who haven't sold me their shares yet. So that's what the $94 million is. That's the interest of these remaining holdout shareholders into the consolidated statements. So the $94 million is called minority or non-controlling interest. Is the interest of the shareholders in the subsidiaries who have not given us their shares yet. And they may never do that, right? They may keep their ownership at 10 or 20%, whatever. So this keeps track of their interest in the consolidated firm, because some of the consolidated firm does not belong to Merck shareholders. It belongs to these other guys who have a small stake in some of the subsidiaries. So Merck shareholders have most of it. See, 25,907 is the Merck shareholders. And then these other guys have a little stake in this combined entity, $94 million stake, right? So when you combine the two of them, you get to the total equity amount. So when you see non-controlling interest, that's what it means, right? That you own some you control subsidiaries, but you don't own all of them, right? There's some shares that somebody else holds.
And Val, is it entirely a question of control, or is there also a threshold of being a majority shareholder in the subsidiary?
Well, majority shareholder is always 50%, Robert, right? So it's always a question of control. In fact, you can control a subsidiary at less than 50%.
Yeah, that's where I was trying to drive.
No, that's true. So if you control any subsidiary that you control gets fully consolidated. So there are some cases where companies get into contracts with foreign governments where you have full control, but 90% of it is still owned by the foreign government, right? So you can own like 10% and still have full control of that subsidiary. So that gets consolidated as well. And in that case, of course, the non-controlling interest will be much larger, right? Because the non-controlling interest, that foreign government has a big stake in that company, right? So control is the predominant criteria here, not ownership. That being said, if you get 50% or more, then you have control. Okay, so now the very last account is this thing here, the accumulated other comprehensive loss account. And going back to my notes, I have this account on every balance sheet. There is a accumulated other comprehensive income account right here, which is also a loss, by the way, because it says if it's in parentheses, it's a loss. So I'm going to use this one because it's easier to see. Right. So we got to talk about what is this accumulated other comprehensive loss account all about, okay? Because it's not small. This could be a pretty large number. So here it's about $6 billion for Pfizer, and J&J actually has even more. It has about $15 billion here, right? So first thing to notice, guys, is it's in parentheses. What does that mean? It's a loss, right? So this is some kind of a cumulative loss because it reduces shareholder equity. So if it's in parentheses, that means that your equity is being reduced because of whatever is going on with that account. If it's outside of parentheses, well, that's an accumulated gain of some sort, which helps your shareholders, right? So if it's in parentheses, it reduces equity. If it's outside of parentheses, it increases equity. But what is it, right? it kind of looks strange because it has the word income, but it's on the balance sheet. So say, okay, why is income on the balance sheet? Why is it not on the income statement, right? So let's see, let's talk about this. Why is it on the balance sheet? Well, it's on the balance sheet because it's not income, it's accumulated income, right? It's accumulated other comprehensive income. So this is very similar to retained earnings. Remember, retained earnings is accumulating what? What is retained earnings accumulating? You know that. Robert?
The net income minus.
Net income, right?
paid out.
So yeah, retained earnings accumulates net income. Well, this account accumulates a different type of income called other comprehensive income. So it turns out that there is more than the income statement when it comes to income. There is the income on the income statement, which gets accumulated in retained earnings. But then there's this other comprehensive income, which gets accumulated in this account, right? Now you should push back and say, Val, why is there income that's not on the income statement? Well, I'm glad, that's a good question, right? So the reason why there is income that's not on the income statement is because companies lobbied FASB to create that category. There were some transactions which generated gains and losses on a yearly basis, which had nothing to do with managers. And they were all unrealized gains and losses. So managers were very concerned that the income statement got very noisy, right? Because every year it would jump and down like a yo-yo for things that have nothing to do with them. So FASB agreed that there's certain amounts that better not to report on the income statement because one, they're outside of the control of managers. Two, they're temporary in nature, right? And three, they're all unrealized. Right, unrealized, outside of the control of managers, and temporary, most likely, right? So those three conditions have to be met. So if an item meets those three conditions, managers can report it outside of the income statement. Where? In that fifth statement that we've been leaving out until today, right? What was that fifth statement called? Let's go find it. All right. You see this thing? The statement of comprehensive income. That's not the income statement. The income statement is right here. See, consolidated statement of income. But then right after it, we have the fifth statement, which is the comprehensive income statement. So in the comprehensive income statement, I'm going to report this other income that has been left out of the income statement. So let's see here for Pfizer. It's very nice, nice presentation. So the comprehensive income statement takes the income statement number, which is 9843, which is this number right here, straight from the income statement, right? So this is your net income. And then makes an adjustment for it by including all these other gains and losses, which are not on the income statement. So let's see. I lost, in addition to making $9.8 billion on the income statement, shareholders lost $648 million because of these four other things. Right? So they lost these things from the four other sources. So if you actually look at their total income, it was only 9.1 billion. So 9.8 was reported on the income statement, but the comprehensive number is 9.1. Right? Are you guys with me so far? Kind of, sort of. Right? So 9.1 is the total comprehensive income, which adjusts for these four items, which are not on the income statement. So these four items keep accumulating in the AOCI. The other comprehensive income accumulates these numbers right here. Well, it accumulates these numbers. So retained earnings accumulates net income. Accumulated other comprehensive income accumulates these numbers. All right, so let's just see what they are. So they're really only four of them. They're always only four of them. For every company, there are only four, right? Some companies don't have all four. They may have two, they may have three, they may have all of them. But you cannot have a fifth one because FASB only allows four particular gains and losses. The first one is any unrealized gains and losses on derivatives you might hold. So what in the world are derivatives? Well, derivatives are financial instruments used to manage your risk, right? So these are like insurance contracts. So if you have gains and losses on these insurance contracts, which have not been closed out yet, then these gains and losses get reported here. Okay, this offsets items on your income statement because these are insurance contracts, right? So gains and losses on those get reported separate.
So Val, when you say insurance contracts, is that something occurred where you're being paid by the insurance company or like?
Well, I use
negotiating
insurance
contract?
yeah, I use insurance contracts, so I don't have to explain exactly what they are, but so here's how you think about it. So this will be like Southwest Airlines, right? Buying futures on jet fuel. So they enter into contracts to get a fixed price on jet fuel in the future, Annalise, right? Why they do that? Because that's their main expense and they don't want to be subject to market fluctuations. So they will enter into a contract with another entity to sell them jet fuel at a pre-specified price. So that's a derivative, okay? So you can see it's kind of like an insurance against the possibility that prices rise for the jet fuel, right?
So if prices do rise, then they're gonna classify that as a gain.
Yeah, they're gonna have a gain on this, which is gonna offset the higher costs on the income statement. Make sense?
But
But one other thing, when you,
1 second, percentage, yeah.
I was just gonna say the three items that you said, they're outside the control managers, they're temporary in nature, and then what was the third thing?
The temporary, they're out, the unrealized. So all
They're
these
unrealized.
are unrealized. So the transaction hasn't been closed out yet, right? So these derivatives are still active in this case, right? So these are usually futures that they buy, right? So they buy and sell futures to try to control their exposure to the product market. Percentage?
Hey, well, if these are insurance contracts, right? Are the risks not locked in? Why do you have a profit or a loss? Because you know what you're going to get.
What's that?
So with the insurance contract, you know what you're going to get, right? The
Well, these
risks
are
locked.
percentage, these are mark-to-market contracts, right? In the derivative market, when you buy futures, the value of these futures fluctuates every day, right? So the gain or the loss on the futures is going to offset your gain and loss in the product market.
Okay.
So these are like, I mean, they're kind of similar to options, except that they're called futures because you have to deliver the underlying contract. So, you know, basically, so the example of Southwest, they will buy, let's see, would they buy or would they sell? Yeah, so they're gonna basically buy jet fuel futures at a pre-specified price, right? So that way, whatever they have to pay for the jet fuel gets offset, you know, any changes in the jet fuel market, they offset against their future contract, right? So if jet fuel prices go up, the value of this contract goes up, right? So they make money on the contract, but they lose money by buying the jet fuel in the market, right? So that kind of balances off their gains and losses. Do you kind of see how it works?
Right.
Right? So it's quite, I mean, it's a complex instrument. So I unfortunately can't get into too much detail, but that's the logic, right? So you make money on one contract to offset losses in your business, right? So that way you make the same regardless of what happens to the price of oil, right? So it's like insurance. All right, so that's one of them. The next one is any gains and losses on bonds. So if you're holding some bonds, but you're not holding them until maturity, these bond values will fluctuate. You haven't sold them yet, but you will have gains and losses on your holdings. So these gains and losses get reported here. So that's this one. The third one is gains and losses on your pension plan. So if you offer a particular type of pension plan, the value of the pension plan assets and liabilities fluctuates. It fluctuates every year because you keep changing the assumptions on this thing, right? So these are all present values, they're complex to calculate. So every time you do the calculation, you end up with a different value. So this absorbs the change in that value. And the last one are gains and losses from foreign currency changes of your foreign subsidiaries. So every year, you have to convert the balance sheets of the foreign subsidiaries into US dollars. So every time you do that, you come up with different numbers because the value of the dollar changes. So these gains and losses get reported here as well. It's not so important to kind of understand the underlying transactions. That's more advanced, but I want you to understand the logic of it. So let's take the foreign subsidiaries, for example, right? Every time I make this calculation, I'm going to get a different number, right? But do managers have any control of foreign exchange rates? No. So why should I put that number on the income statement? Next year, it might reverse. So look what happened here. You know, for the cumulative translation adjustments, in 2017, there was a gain. In 2018, there was a loss. In 2019, there was a gain again. Right? What does that have to do with the operations of the firm? Nothing, right? You just happen to be in a country where the foreign currency exchange rates change. Right? And you're not selling the division, right? If you sell the division, that's a different story. Then you realize these gains and losses and put them on the income statement. But you're not planning on selling your divisions, right? So, okay, the value of their assets and liabilities change because of the dollar. Okay, fine. But don't put it on the income statement. So that's the logic for keeping them out, is that all four of these have nothing to do with managers. Right? These are driven by market conditions, they're driven by changes in life expectancy or exchange rates or interest rates, all outside of the control of managers. And they're not realized yet. So why pollute the income statement with these numbers? So we don't want to do that. So that's why we report them separately. And we accumulate them in this account on the balance sheet, which is the AOCI. Right? So this account accumulates all of the ongoing unrealized gains and losses of these four types. And it's $6 billion negative so far. Right? If I close a position, then it has to go into retained earnings, right? Because then it hits your income statement, whether you like it or not. But as long as these are unrealized, they go in here. And you can say, well, yeah, there is a cumulative loss. How important is it? Probably not terribly important, but if you were to liquidate the company today, yeah, that loss will be realized. That's what you're saying, right? But of course, you're not planning on liquidating the company today, so it doesn't have the same weight as retained earnings and net income does. So what I like to do, guys, is I would look at this number to understand what the cumulative balance is. But then when it comes to the income statement, I would focus on net income number, because that's the number that's going to continue to be in the future if the company continues to execute things the way they have been. This number fluctuates a lot. So I tend not to include this number in my forecasting because I frankly don't know how to forecast it, right? Nobody knows what these exchange rates will do in the future.
It just sounds like a magic number used to balance the book.
A magic number?
To balance the book.
Yeah, it is being done to balance the books. Yeah. It's there because otherwise your assets will not equal to the liabilities and shareholder equity. I mean, it has economic meaning behind it, but it does change a lot from year to year. So that's why it's not very useful as forecasting. I mean, let's go back to the very first class. Why are we doing all this work? We're just trying to figure out how well the business will do in the future, right? Well, this number doesn't help you do that very well. So that's why it's not on the income statement. So my recommendation is look at the net income number and check the accumulated, check this AOCI number to understand the total value lost as up to date, but do not expect that this number will remain the same, right? So this number may change quite a lot in the future, and the company is not going to be liquidating these things. So these will not necessarily turn into actual losses. And don't blame managers for this number. It's not really it's not fully their fault. Well, most of the time it's not their fault. Okay. So don't evaluate your managers based on this. All
So
right,
this number-
questions? Yeah, Maria?
So this number, since it's not on the income statement, it's not a part of net income and retained earnings, it doesn't affect the dividends.
it will not affect dividends in general, right?
But it actually does affect the money in like the overall.
Well, it affects your book value of equity, right? But remember, none of these numbers are cash, right? These are all accrual accounting numbers.
Right, okay.
So you can't think of them as affecting your cash balances. I mean, your cash balances are on the balance sheet under cash, right? If you want to look at cash, look at cash.
Okay.
This is keeping track, right, of unrealized gains and losses in the business. Right, so there are these extra 6 billion unrealized loss that is sitting there, which yes, may be realized, may not, depending on what happens between now and the time they close these positions, right? Right, so that's what this number is. And that's it. So that kind of covers all of these accounts. We talked about common stock, other paid in capital, retained earnings, and treasury stock. So you can see here, Merck has actually bought even more. They've bought, $55 billion worth of their own common stock. So look what has happened to them. So they had this $81 billion, but because they bought back $55 billion of equity, now they're left with only $25 billion of equity. So this is actually quite common these days, where equity is pretty low, mostly because of repurchases. Right? So they keep buying back their shares. The remaining shareholder stake in the business keeps going higher and higher. And this has some implications about net income. So let's take a look at that last, the last disclosure, which is earnings per share.
Sorry, Val, can I just interrupt while you're kind of on the
Yeah,
subject?
sure.
Can you scroll back down to the non-controlling interest line item?
The AOCI?
Right, yeah, the non-controlling interests.
Okay, yep.
So if that reflects what the other guys own, why is it a positive number?
Well, because they own a stake in that consolidated company.
But the 94 is what the portion that the other guys own though, right? Or is that?
Well, the 94 is saying that these non-controlling shareholders have a stake in the consolidated company, and that stake, the book value of that stake is $94 million.
Okay.
So think of it as them owning part of the net assets of the consolidated firm. $94 million worth of them, right?
Got it. Okay.
But this is book value, right? It's not market value. We don't know what the market value of that claim is.
Okay, thanks. I was just getting hung up on the language.
Yeah. So that's the book value of their claim. So out of the 26 billion, these guys own 94 and the Merck shareholders own 25.9. Right? So that you can split it backwards like that. All right, so earnings per share. So this is the last disclosure. So you can see companies report two different EPS numbers. So there's a basic earnings per share and there's a diluted earning per share. So this is only the earnings per share to Merck shareholders. See how we remove the interest of the minority shareholders right here? So we get rid of the non-controlling shareholders' gains and losses. So this is just to Merck. So we have these two numbers that always get reported, and that's true for any company. Any company is going to give you these two numbers, basic and diluted. The big difference between the two is the total number of shares that you use to calculate. So the basic earnings per share just use existing shares as of today. So they take all the outstanding shares as of today and do the calculation using those. The calculation, by the way, I have it right here. Come on. Okay, so the calculation for earnings per share is like this. It's net income minus preferred dividends divided by shares outstanding. Okay. So the basic just takes existing shares and does the calculation based off of them. The diluted EPS takes into account all the possible shares that could be issued based on past events. So it takes into account stock options, stock grants that haven't fully vested, convertible preferred stock, convertible debt. So it takes into account all the possible shares that could end up in the market in the future, given on what you have already given out as securities. So the diluted number is going to be a lot, it's going to be lower than the basic number, always, right? It's always going to be lower because it has more shares. So you're always going to come up with these two numbers at the end of the day. So going back here, you can see they're kind of close, but not really for Merck, right? So they're off by 3 cents. Why? Well, because these numbers, the diluted numbers, are using more shares. And that's always the case. So which one would you take if you can pick between the two? Which one do you think is more valuable for investors to think about?
Diluted.
Diluted, very good. You want to be conservative, right? Because you know what? These shares, even though they're not outstanding yet, they will be outstanding in a few years. So you might as well take them into account when you're thinking about the earnings per share that you're getting, right? So I always say, take the diluted. Diluted is like a worst case scenario. Basic is best case scenario. So basic is the lowest number of shares that you can have. Diluted takes all the possible shares into account as well. So the diluted number is more conservative and therefore more valuable.
Now, if a company doesn't have share-based compensation, like they don't do share options, they don't do share grants, maybe they don't have preferred stock, then they would be the same, right? It wouldn't necessarily be lower in that case.
Yeah, they could be the same in that case, yeah.
Okay.
So the instruments we're looking for is stock grants, right, which vest over time, stock options that haven't been exercised, stock warrants, which are like long-term options that could be exercised, convertible preferred stock, right, which could be converted into common, and convertible debt, which could again be converted into common. So those will be the 5 usual suspects for the difference. And analysts, you're right. If you don't have any of these securities, then basic and diluted will be the same. There will be no difference between them. But the diluted number will become the basic number in a few years. So you might as well use the diluted number, right? You might as well use that number because it's more conservative. It's closer to reality, I think, than the basic. Questions here now? Okay, so now looking back at the balance sheet, so we've kind of taken care of all the tough questions, right? So we looked at accounts receivables, we looked at inventories, we looked at property, plant, equipment, we looked at intangibles, we talked about all these liabilities that companies have, and then we discussed the equity side. So that takes you on a walk through the balance sheet. Yeah, there's a lot more to it, right? So this is still like the tip of the iceberg, but it gives you an overall idea of what these numbers mean. In your class on financial statement analysis with Suresh, you guys are going to dig deeper into these numbers and see how you can use them to make business decisions. So we haven't really gotten there, right? We kind of we're thinking about the numbers and their meaning, but we haven't really made the jump to how would you use them in, say, mergers and acquisitions, or in picking stocks or valuing companies, but that is to come. So in the financial statement analysis class, you guys will do that. So you need this information to do that in that class too, but just for yourself, for your own benefit. How do you get better at it? Read annual reports. Just start reading annual reports. The more you read them, the more the better you're gonna get at it, because you can see, you're gonna start seeing patterns in the way companies report certain things. And also invest. You don't have to invest a lot, invest a little, but something to give you an incentive to read the annual reports, right? There's no annual reports for crypto, right? But if you want to buy shares or bonds, then you can easily pick up the annual reports and, just learn about different companies. So I always find out that if I put some money at stake, I'm more likely to read the reports. So yeah, you can put like, $100, $200 in companies you're interested in, and just follow them, and you'll get much better, right? So it's just practice. All right, let's take a 10-minute break now. We'll come back and finish off by looking at the last statement of cash flow. Okay? So I'll just get some coffee. I'll be right back. Hey, guys, let's come on back. I think Nicole wants to remind you about something. Nicole, are you on?
I am.
Okay, let's just give people a second to jump back on.
Okay, perfect.
Val, it's funny you were speaking about Jack Welch earlier. I actually went through the program as part of like FedEx's International Business Essentials deal.
Uh-huh. Oh, no. How about that? Don't show this anymore.
I know. I'm throwing it away after that. Throwing it.
Yeah, it's funny how things change, right?
Uh-huh.
Yeah, usually it takes a long time to find out the effect of your decisions.
He had some good views on managing people, though. He had the whole, the promote the top 15%, fire the bottom 10%, and use that to elevate the other, 75% of the company.
Yeah, but who says that's the right way to do things, right?
I didn't say it was the right way. I said he had some interesting views on how.
Interesting, right? Interesting. That's true. That's true. He had views, just like all of us do. But people sometimes elevate these folks to the level of God, right? They're not. They're just people. They make mistakes, and you can't just take what they say as the truth. You always think about it, and sometimes it turns out what they were doing is not that great.
Yeah, the idea of using A people to motivate C people and B people to move up into A, and how you can increase productivity. It's an interesting way of looking at it. It may not be the best way, but it's an
right. It's kind of like a tough thing to do is separate people into A, B, and C, no? Nobody wants to be called a C person.
Right. Well, that's just it. And what do you, it's hard to put people into that 10%, right?
Very tough. Yeah, he was pretty tough. He was kind of ruthless at some point, right? He did a lot of restructuring, and I'm sure he fired a lot of folks. Yeah, I mean, definitely take whatever you think is good out of it. I don't want to discount all the things he said, because frankly, I haven't paid a lot of attention to what he has to say, but I'm sure there's some good things in there. All right, Nicole, take it away. You wanted to say something, remind people about a career fair?
Yes. Yeah. Thanks, Val. So just want to let everyone know we have the career development session today at 12:30. I just want to underscore the new start time. So before it was 12:15, we're giving people time in between class and the start of the session to grab coffee, grab food. So the new start time will be 12:30. And that's it. Thanks, Val.
Yeah, so you're saying that I have to finish at 12:15, huh?
Well, you know what? We now have a start time of 12:30. I think
you have to
people want to grab
break.
food.
Can I also come to the career fair?
Yes, please come on. It's a development session with Denise Weber, who's the HR head for Janssen.
Oh, okay. Because with the way Bitcoin and Dogecoin are going, I think accounting is losing its relevance. I might need to switch careers soon.
We'll send you
Did you ever buy any?
All right.
Did you buy any, Val?
What's that, Kenyatta?
Did you buy any?
No. Not me. I'm a dinosaur. I can't buy these things. It goes against everything I believe. But I almost bought Dogecoin though. But yeah, just for fun. But I didn't.
Good.
I wish I did. Okay. So last thing we're going to talk about, guys, is the statement of cash flow. So you've seen it already. We've talked about it, but there's one thing we haven't discussed is the way the cash flow from operating activities is presented. So this is really getting us into module 11. And I mean, I sort of ran out of time in some sense because, this stuff is kind of complex and I'm looking at the clock and I only have an hour to do it. So as far as the exam is concerned, and please don't turn off your cameras, this stuff is not going to be on the exam. Okay, so module 11 is not going to be on the exam because there's just no time. So we're going to stop the material as of module 8 and module 11. Think of it as stuff you need to know, but we'll just leave it at that. So it's more manageable that way. Okay, but let me show you what I mean when we say that cash flow from operations is strange. So this is the cash flow statement of Starbucks Going on outside, a lot of noise. So this is the statement of cash flow for Starbucks, and a few years back, 2018, 2017, and 2016. So the three main sources and uses of cash, as we know, are cash flow from operations, right? So if you just look at the total numbers, they're very easy to interpret. So in 2018, Starbucks made almost $12 billion in cash from operations. Then you have cash from investing activities. So they spent about $2.3 billion on their investing activities. And then remember, you have cash flow from financing activities. So this is the last category. So that's about $3.2 billion spent on financing activities. So we've seen that in module 1, right? And we kind of talked about what kinds of transactions go in different bins here. So for example, the cash flow from operations includes any cash flow related to the company's income statement. So usually, income statement accounts. So income statement related cash goes into cash flow from operations. Cash flow from investing activities includes cash flow from long-term assets. So any kind of long-term asset, property, plant, equipment, intangibles, it goes in here. We have acquisitions in here. And we also have marketable securities. So remember, that's the place where they park their cash until they need it. So any kind of marketable securities also get reflected in here. And then financing activities was the purchase or sale of the company's own securities. So purchase or sale of bonds, notes, and own stock. Right, so these are the company's own securities. So you have things like repurchases, dividends, debt issuances, right? Debt retirement. So these are the transactions that affect this part of the cash flow statement. So then what the company does is once it breaks it down, it sums them all up. So this $6.2 billion is just the 11, the -2, and the -3 together. And then they reconcile that with the balance sheet to show exactly why the cash changed the way it did, right? It's a very helpful statement because you don't need to know much accounting to make sense of these numbers themselves, right? So when you look at the totals, they make sense even to people that don't know anything about accrual accounting, because we all have an innate understanding of cash. So that's where the benefit of this statement lies. That these numbers do not depend on accounting assumptions, okay? They are actual cash flow, and we all kind of have an idea of what cash looks like. So it makes the statements more understandable. The other reason why it's very important is that we know that the income statement is not cash amounts. And so therefore, at the end of the day, if you want to make money in any business, you better be generating cash. So this kind of shows you where the money is. Income without cash flow is not going to make you wealthy, right? In the long run, the company must be generating cash flow from its operations to be successful. So you can see that Starbucks is already in that stage where they're able to generate a lot of cash flow from operations, enough to keep the company growing, because see, they're able to invest. And then on top of that, they're even paying back some of the money to their creditors and shareholders. So you can see things like repurchases, cash dividends being paid, they're all going to be listed on the cash flow statement right here. Yeah. So a very helpful statement to kind of examine. People usually look at it together with the income statement. So once they figure out how much income the company generates, they will turn over to the cash flow statement to understand whether they're also generating cash flow related to that income. So for Starbucks, for example, this is their net income number. See, it says net earnings, including non-controlling interests. So $4.5 billion of net income. This thing comes from the income statement, as we know, right? So this from the income statement, we get this number. And then what you see here is that the cash flow is actually far greater than the net income provided from, the net income number. So the company actually made $11 billion in cash flow, even though they only report $4 billion in income. And the year before, they reported $3 billion of income, but made $4 billion cash. And then the year before that, same thing that you see, right? So the cash flow position is even stronger than what's indicated by the income statement. So that's usually a very good sign, right? That the company is generating a lot of cash flow here. All right, let me stop here and see if you guys have any questions about these numbers themselves.
Yeah, Val, just a quick question. It looks like it exploded in 18, but it was solely because of deferred revenue, right? That's the difference. Would you happen to know just what happened?
Yeah, that's what happened this year. Yeah.
Yeah. Do you happen to know why, or just curious?
So what is happening here is that they have received a lot of cash before actually delivering the product. So deferred revenue went up by $7 billion. I'm trying to think, why did deferred revenue go up by $7 billion?
Yeah, just so, I mean, I'd look it up myself. I'm just curious. I figured maybe if you used it as an example, you kind of figured you looked at that yourself. No worries. I just was just such a stark change. Just kind of.
Yeah, no, I noticed it, but I didn't go back to dig. I mean, I'm sure that will be discussed in the 10K for that year. It's just that it's a 2018 number, so I have not gone back to look at it. Good question. Yeah, that's my bad. I should have looked at it.
No worries. No worries.
Yeah, but it's very easy to see, right? That it all came from here. And then they also acquired a joint venture. So I'm thinking that this might have been something to do with their acquisition of this entity, but I'm not sure. I'm not 100% sure. But even in the previous years, right, it's very comforting to see that their cash flow from operations tends to exceed their net income. If the opposite was the case, then I'll be a little bit worried, because remember, it's not that hard to report good net income. It's a lot harder to actually report the cash flow. So if I see a lot of net income without much cash flow, then I'm not as positive on the company, because I like to see the money behind it too, to make sure it's not just accounting choices driving these numbers.
Well, 2018, there was this tax thing that happened, right?
Yeah.
Would that somehow get into this?
No, this wouldn't be based off of the tax. This is really the deferred revenue account, right? So there's something happening with deferred revenue where they have received a lot of cash from customers for things that they're gonna do later, but I don't know what this $7 billion relates to.
I just posted in the chat. It looks like they had like a royalty with Nestle.
Ah, there you go. So that could be it. Yeah, that would work, right? If Nestle gives them the money now for something that they're gonna do later, that will explain the deferred revenue account, right?
7 billion.
Yeah, well, it must have been a big contract. Right, so they got the money up front, and they're gonna deliver the goods later. All right, so the big issue with this cash flow statement, guys, is this number right here, the $11 billion, and how we actually get to this number, because you can see the presentation is a little awkward. It starts with net income, and then you don't actually see the cash coming in and cash going out for different items. What you see is a bunch of adjustments. So let's read this carefully. It says adjustments to reconcile net earnings to net cash provided by operating activities. You guys see that? So let's think about what that means. They're not showing us where money came from and where it went. Instead, they're showing us how to go from the 4 billion to the $11 billion number on the bottom. So this is a reconciliation of net income into cash flow from operations. Really? Somebody's cutting their grass. Oh, great. They're cutting my grass. Sorry about that. Okay, so this is showing us how we go from net income into cash flow from operations. This is not showing us where the money came from and where it went. So these are all actual adjustments to the net income number in order to turn it into cash flow from operations. which means you cannot interpret these numbers on their own, guys. You have to interpret these numbers relative to what's being reported in net income, because they're all changing the net income number to turn it into that cash flow from operations. That makes it confusing. So for example, look what they do. So the first adjustment is depreciation and amortization. You guys see that? So they take depreciation and amortization and they add it back to net income. Why would you do such a thing? That kind of, if you just think about it, say, first of all, depreciation and amortization is a non-cash item. What is it doing on the cash flow statement, right? It has no effect on cash. Well, that's exactly the point. It doesn't have any effect on cash. It was removed from net income, from earnings to get to the net income number because it's an expense. But here I'm adding it back because it should not have been removed, right? So it's an adjustment. So once you realize these adjustments, things get a little, murkier. So we want to talk about this. I want to walk you through these adjustments to understand what they are. This thing is called, this format here that Starbucks follows is called the indirect format for the cash flow statement. Indirect. And it's indirect because of this, right? Because it's showing you how to go from net income to cash flow from operations. It does not show you where the money comes from and where it goes. It's only about the cash flow from operations. The rest is fine. See, here I can actually tell you that they got, they spent $192 on the purchase of investments. They got $459 from sale of investments. The rest of the statement is direct. It's just this first part that's indirect, right? That requires some more thought. You may wonder, why do they do it this way? It's a great question. They do it this way because it's very important for shareholders to understand why there's a difference between this number and the cash flow from operations. So this reconciliation is of primary interest to shareholders to better understand the accounting choices of the firm. So it's required under US GAAP to provide this reconciliation. So even if you choose to use a direct method here, which some companies do, very few use a direct format. Even if they choose the direct format, they still have to give this reconciliation somewhere else in the notes. So given that they have to provide it anyway, companies just put it in the statement of cash flow to begin with. All right, so that's the reason. All right, so the best way to explain this is to try to do a statement of cash flow on our own, right? So we're gonna do one right now together so I can show you how this works. Right? Of course, we're going to do one that's simpler, which is based off of these financial statements right here. Okay. So I have an income statement for Java House. This is the company we used in module 3 a long time ago. And I have the balance sheet for this company together with some information on what I did during 2017. So this is for the 2017 fiscal year right here. So the company made 250,000 in revenues. And then they had a bunch of expenses. They also had a gain on the sale of land of $8,000. This is a negative number because gains reduce expenses, right? It's being shown as part of the expenses, but it's really a gain. And then these things together sum up to 218. So 250 minus 218 gives us the net income of 32,000. So that's what happened on the income statement. And then on the balance sheet, of course, I have a bunch of asset, liability, and equity accounts, but the cash went from $10,000 to $35,000. So what I want to do with the statement of cash flow is to explain. I want to explain the $25,000 change in cash. That's what the statement will do, right? In particular, I want to see how much is it from operations, how much is from investing, how much is from financing, because they're not all created equal, right? I want to get a lot from operations if I can, and then the other two are not sustainable, right? So that's what I'll do. Everybody with me? All right, so I'm going to pull up an Excel spreadsheet and we can kind of think through it and see what the actual statement of cash flow would look like. All right, can you guys hear me okay? Sorry about the noise in the background. All right, so I'm gonna just start out and make it a little bigger for us. All right, and make it bold. So on the very top, I have just the name, statement of cash flow, Java House. The year ended December 31st, 2017. All right, so the very first thing is cash flow from operations. Cash flow from operations. All right, so here's how I do it. I'm gonna take my net income number and I'm gonna convert it step by step into a cash flow from operations. That's the indirect method. So I start with net income. Net income is $32,000. And I want to convert it into cash flow from operations by making adjustments to it, okay? Because I know, or you should know too, that net income is not cash, right, Nicole? Net income is an accrual number, right? Sales may or may not be cash. Expenses may or may not be cash. And then on top of that, there are a bunch of other things I spend money on, which are not on the income statement because they haven't been used yet. So I got to be very careful and systematic in this conversion. The first adjustment I do, right, is to think about, are there any non-cash expenses on the income statement that I should reverse? Let me say that again. The first thing I want to do is look and see if there are any non-cash expenses on the income statement that should be reversed. So Tina, do you see anything that's obviously non-cash?
On the income statement that needs to be reversed.
Yeah, that is a non-cash expense, right? I want to remove things that have nothing to do with cash. That's my goal. I know there are a bunch of things on the income statement that have affected my net income, but some of them are non-cash, so they really shouldn't count. So do you see anything that's non-cash that shouldn't count really?
Like cost of goods sold.
Well, cost of goods sold may or may not be cash, right? So I
Okay.
don't want to remove the whole thing.
Okay.
Which one is like clearly non-cash? I just said it like 5 minutes ago.
Gain of sale of land.
Depreciation.
Not part of it. Depreciation, right? Gain on sale,
Okay.
I'm also gonna deal with Colin in a second, right? But the one that's obviously non-cash is depreciation. So this amount right here, the depreciation account, I want to remove this $10,000. I want to get rid of its effect on cash flow because it has nothing to do with cash flow. So even though it reduced my net income, I'm gonna add it back and pretend that it wasn't there to begin with. Are you guys with me? All right, so this is very important to understand. If you don't get this, the rest will look even more foreign. So I'm adding back depreciation to net income because it was a non-cash expense. And now I want to convert income into cash flow. So that's why this income doesn't belong there anymore. Sorry, this depreciation doesn't belong there anymore. So to remove its effect, I'm going to add it back. So say, let's not count depreciation because it doesn't affect cash flow. So I'm going to add back depreciation. That's the very first adjustment. Always, this is always the first adjustment. Any depreciation and amortization has to be added back to the company's cash flow because it does not affect cash. All right, so I'm going to put the $10,000 right here. So now I'm at 42,000, right? So see how I'm adjusting, and I'm now at 42,000. So that's one adjustment. All right, the next adjustment, as Colin pointed out, is there's this strange gain on sale of land sitting here, and say, okay, where did that come from? Well, it came from this part right here, where I sold land costing $20,000 for $28,000 cash. You guys see the gain? All right, it's the $8,000 difference. That's how we did these gains. And, you know, it goes on the income statement like it always does. But I have two problems with that number, right? Problem number one is I didn't get $8,000. How much did I get for that land?
28,000.
28. So 8 is not the right number, okay? But there's an even bigger problem is that where does this cash flow belong of 28,000? Is it operating, is it investing, or is it finance?
Investing.
Investing.
It's investing because it's a long-term asset account, right? Long-term asset accounts are not operations. They're investments. So long story short, I gotta remove this gain, right, Colin? It doesn't belong in my operations. It just doesn't belong here. So I gotta get rid of it. How do I get rid of a gain? The gain is already in the net income number. How do I remove it? Well, I subtract it, right? It was added to net income, so now I'm gonna subtract it. So let me get it out of there. So that's what I'll do. So I'm gonna say less gain on sale of land. This has to go away because it's not operating and it's not even the right amount. It's not the cash, it's just some gain. It's an accounting gain, right? So let's get rid of it. Nothing to do with cash for operations. I'm gonna worry about it later when I do the investing, right? But for now, I'm just removing the gain. So that's $8,000. Okay, good. So I took care of 1 and 2. So I can put little check marks next to them. Right, so I took care of the depreciation and I made an adjustment for this number. All right, so now I have to keep thinking, what other adjustments might I have to make? All right, so now I'm gonna start going line by line, right? So let's look at sales first. So sales is 250,000, right? However, we know that some of the sales are on credit. So I may or may not have gotten the whole amount. I don't know. How do I figure it out? I'm gonna have to now start making links to the balance sheet. All right, which account on the balance sheet will tell me something about how much of these sales were on credit?
Accounts receivable.
Accounts receivable. Let's look at accounts receivables. So accounts receivables went from 34,000 to 39,000. What does that mean about my sales?
You have 5,000 more on credit?
Yeah, that means that 5,000 of those sales were on credit. You guys agree with me?
Yes.
So net of whatever was received, 5,000 is still stuck in these accounts receivables, right? So that means that I have to make an adjustment to my net income for these $5,000 that has not been received in cash. The cash received from customers was not 250, it was 245. How do I know? Because I have an increase in accounts receivables of $5,000. Right, here's another way to see it. This is a little tricky, right? Which is why we always, we waited until the end. But so let's look at this accounts receivable account. So accounts receivable. The best way to see it is just look at the account. So I know my beginning balance was 34,000. This is my beginning balance. I know my ending balance was 39,000. And assuming that first I make the sales on credit, the new sales are $250,000, right? What I'm really after is not the sales, I'm after the collections. So what I want to know is, what were my collections during this year? Right? Are you guys with me? So this is this number X. So I say, look, I begin with 35, I get another $250,000. I must have received something to get to 39. So what did I receive? Well, I must have received $245,000. Right? So you can see that the sales are overstated by $5,000 relative to the cash flow. So I got to make an adjustment for that. How do I make an adjustment? Well, I'm just going to remove $5,000 from these numbers. So I'm going to say less increase in accounts receivable. So the fact that my accounts receivables went up means that there's $5,000 I did not collect from my customers relative to net income. It's all relative to the net income number. So $5,000 was non-cash. All right, good. Now let's move on. Say, okay, that's good for sales. What about cost of goods sold? Is that all cash or not? Well, I don't really know, right? So for cost of goods sold, I actually have to examine two accounts.
Inventory.
Yeah, I have to examine inventory, and I also have to examine accounts payable because some of the inventory might have been bought on credit.
Got it.
But let's leave accounts payable out of it for a second. Let's assume everything was bought for cash. And then we're gonna deal with accounts payable later. All right, so if everything was bought for cash, how much did I actually pay for this cost of goods sold this year? Did I pay for all of it or for just some of it?
Just some of it.
How much did I not have to pay for?
Less your inventory.
Yeah, so look at the inventory, right? The inventory went down by $6,000 during the year. You guys see that? Why did it go down? Well, I must have sold some existing inventory. And the cool thing about selling existing inventory is I didn't have to spend the cash. I already had it. It's like selling something you already have. You don't have to buy it. So even though it's showing 148,000 cost of goods sold, not all of that was purchased this period. 6,000 of that was purchased in the past, and that means no cash was spent. So therefore, I can make another adjustment, right, to reduce my cost of goods sold by $6,000 because $6,000 is non-cash. So that will be my next adjustment, and that's good for cash, right? Selling existing inventory is good for cash, right? Because I didn't have to pay for it. So I'm gonna add decrease in inventory. And the decrease in inventory was $6,000. Right? So that's good. So then I keep moving. All right, let's look at the next one. The next one is the insurance, let's see, wages expense. So if I look at wages expense, there doesn't seem to be any adjustment that needs to be made because there is no account on the balance sheet associated with wages, right? There's no prepaid wages, there's no wages payable. So that means that the wage account is fine. There's no adjustment needed for that account. You guys follow? Right? That must have been all cash because there's nothing left on the balance sheet for it. So all of that must have been cash. So say that's fine. The next account though is insurance expense. So let's look at that account. So there's an insurance expense of $5,000 on the balance sheet, sorry, on the income statement. And there's also prepaid insurance right here on the balance sheet. So what do I do with the prepaid insurance on the balance sheet? What does this tell me? What does this tell me about cash?
How much cash you used in the period.
Yeah, so not only did I pay the $5,000 for the income statement, right? But apparently I also went out and bought some more insurance for the future. Do you guys see that? How much extra did I buy? I bought another $13,000 in insurance. Is this on the income statement? No, because I haven't used it yet, right? On the income statement, it's just the amount you use. But in addition to that, I must have spent another $13,000 for future insurance. And that's cash being spent. So I'm going to have to make adjustment for this $13,000 because that's not on the income statement. It hasn't been used yet. So let's do that. So I'm going to say less increase in prepaid insurance, which is $13,000. So this is another adjustment I have to make. So there's actually a pattern to this madness, right? So here's how it works. If an operating asset is going up, that means you're using cash to build it up. So if inventory is going up, if accounts receivable is going up, if prepaid expenses are going up, all of these will be negative adjustments. Why? Because it takes cash to build up assets. You guys agree? It takes cash to build up assets. That's how you think about it. So it takes cash to build up assets, and that's not on the income statement because I haven't used them yet. So let me reflect that as a negative adjustment. On the other hand, if you guys see that the assets are going down, like the operating assets like inventory, accounts receivables, prepaid expenses are going down, that's actually a good thing for cash because you're liquidating these assets. You're using existing assets for your operations. And that means you don't have to pay money for them, right? Because you already had them on hand. You already had them there. They were sitting there already. So now you're just using them up. So that would be a positive adjustment to cash. So assets going up, bad for cash. Assets going down, good for cash. Right? Make sense? Kind of, right? So either building up or liquidating assets. That's how I think. All right, now let's keep going. I also have to look at my liabilities. So these are the operating liabilities. I have accounts payable that I want to examine, and I got income tax payable. These are both operating accounts. Whoops, where you go? Okay, so accounts payable. Now remember we kind of left that alone when we talked about inventories, but what happened to accounts payable?
Went down by 9,000.
And what does that mean for my cash flow?
You have to decrease it because you paid back.
Yeah, anytime I pay my bill, right, I have to reduce cash. Why is that not on the income statement? Because I'm paying an existing bill, right? It's not a new bill. I already had the bill. So it doesn't show up on the current income statement, but it's cash being spent to pay my bills. So anytime you see a liability, a current liability going down, that's a negative adjustment, right? Because I'm using cash to pay my liabilities. So let me do that. So I'll say less decrease in accounts payable. So there's a decrease in accounts payable of $9,000. So I must have used up cash to have that decrease. And there's another one, income tax payable. So the income tax payable goes together with the income tax expense. So the income tax expense was $11,000. But you can see that 2,000 of this 11 wasn't paid. How do I know? Well, the income tax payable jumped by 2. Right? So some of it is going to be paid later. Do you agree? So that's good for cash, right? Deferring my bills is good for cash flow. It means I didn't have to spend the money now. I'm going to spend the money later. So this will be good. So I'm going to add the increase in income tax payable. So this is the last adjustment that I have, which is $2,000 positive adjustment. So what did I do? I started with net income. I added back my depreciation amortization because it's non-cash. I remove any gains and losses on items that are non-operating, which was my land sale. And then I went through all my current asset and current liability accounts and made adjustments based on what the increase or decrease was. So any increase in current assets, that was a negative adjustment. A decrease in current assets was a positive adjustment. Liabilities got flipped. A decrease in liability is a negative adjustment, and an increase in liabilities is a positive adjustment. I'm only looking at operating assets though, guys. So I'm looking at accounts receivables, inventories, prepaid insurance, and then accounts payable and income taxes. These are my only operating assets and liabilities that I have. I don't look at cash because cash is the end result of the statement. So don't be tempted looking at cash, right? That's the end result. I'm really just looking at operating assets and operating liabilities. These other assets, why don't I look at long-term?
You could also get the 10,000 for depreciation from the balance sheet too. Right?
I could, as long as I haven't sold or purchased any new assets more, right? So it depends on what else is going on in that account. Why am I not looking at these accounts? Long-term investments in property, plant, equipment, and the patent. Why am I not concerned with these right now? Are they operating? No. These are investing, right? This is going to be my investment cash flows. And these right here, the common stock and the retained earnings, these are financing. So I'm not looking at those either. I'm only looking at the ones that are in yellow. These are all my operations. All right, so long story short, let's see what we get. So my cash flow from operations will simply be net income adjusted for all these things that we did. So if I just sum them all up, I got $15,000 cash flow from operations. So that's called the indirect method, see, because I just went from net income into cash flow from operations by making adjustments to that original number. It's also called reconciling net income to cash flow. Right, either way. But I made less in net income, sorry, I made less in cash flow than what my net income was. Because you can see I built up quite a lot of my assets. So I built up some accounts receivables. I built up some prepaid expenses. So that sucked up some of the cash away. All right, think about it. Let me know if you have questions how I did this.
What was the difference when you said like direct method before? Not a lot of people do it, but what?
Well,
what would be like the equivalent
analysts,
here?
in the direct method, there's no reconciliation. You're gonna see exactly where the cash came from and where it went. So you're gonna see things like cash received from customers, right? Cash spent on wages, cash spent on insurance, things like that, right? So it's direct because it's telling you where the cash came from and where it went. This is not that, right? It's not telling you where the cash went. It's just taking one number and making it into another. That's the difference between them. And we're not going to worry about the direct one because it's very rare in the US. IFRS has a little bit more of it, but in the US, it's not a common method. Okay, let's continue. We're not done, right? So we have two more sections, and those are actually quite straightforward. So my next one is cash flow from investing activities. Cash flow from investing activities. So here I'm looking at any cash received or spent on long-term asset accounts and any cash spent or received from any kind of marketable investment accounts, right? Marketable securities. So let's see, what do I have? Do you guys see anything? It says, so here I have purchased all of the long-term investments for cash at the end of the year. Here they are. So I had nothing to begin with. Now I have 15,000. So what does that mean for my cash flow?
Negative.
Yeah, I spent $15,000 buying investments. So I can just say the first item is purchase. Oops, why is this capital? Okay, so the first item is purchase of long-term investments. So purchase of long-term investments will give me, it will give me 15,000 negative. That's one thing I spend money on. What else did I do with these long-term investments? Remember my land? Remember that I sold my land? How much did I sell it for? 28,000. So this is sale of land. This is positive cash flow. Sale of land. I got $28,000 from the sale of land. And I'm trying to check to see if there's anything else. There's a patent which went from 0 to 60,000, but the patent was bought using stock. You guys see this one? So this patent was bought using common stock. This is not a cash flow transaction. So it has nothing to do with cash. So you can just ignore it. It doesn't affect cash flow. So that takes care of the long-term investment. It takes care of the property, plant, equipment, takes care of the patent. So then that's good. I can sum them up. So cash flow from, cash flow provided from investing activities. So now this number would be minus 15 plus 28,000. All right, so that's $13,000. So I'm going to highlight them because these are the ones I'm going to sum up later. All right, so that's the second part. And the last part is cash flow. The last part is going to be cash flow from finance. So this has to do with buying and selling my own securities. Cash flow from financing activities. All right, so let's see what happens with my own securities. I'm told that I issued stock for cash. I also paid a dividend. And of course, I issued stock for the patent. This one doesn't make the cut because it has nothing to do with cash. But the common stock issuance and the declaration and the payment of dividends is definitely related to cash flow from financing. The company has no long-term debt, so there's no need to worry about debt, but equity has these two transactions. So let's record both of these. Sale of common stock. I got $10,000 from selling stock in exchange for cash. And payment of dividend. That's minus $13,000. So cash used by financing activities. This is, of course, the sum of these two. So 10, 13, so that gives you negative $3,000. Oh, not what I wanted to do.
Val, where did you get sale of common stock from?
Right here, see, it says issued common stock at par for $10,000 in cash.
Thank you.
And I can also see it on the balance sheet. You see how on the balance sheet, my balance went from 190 to 260? Well, 190 plus 60 for the patent is 250. So then there's another $10,000 issuance to get to the 260 number. And then the dividends are given to me, right? Okay, so now let's see what's the total. So, total cash flow this year, or total change in cash, is 15 plus 13 plus negative 3, so that's $25,000. And just to check, my beginning cash was $10,000 from the balance sheet. So that means my ending cash better be 35,000. And of course it is, right? So that's the whole statement. Let me make it a little bigger now. Okay, so that's what my statement looks like. Cash flow from operations of 15, cash flow from investing at 13, and then cash used by financing activities of negative 3. So altogether, I get this $35,000. The hardest thing is this one, right? The cash flow from operations, because it requires this careful view of what's happening on the income statement. These are a lot more straightforward because they're just changes in different accounts. All right, so what do you do with that? Well, it's good to know where the cash came from, because this number is going to be the 15,000 from operations is something you expect to persist. So looking at the future, you're going to be projecting cash flow from operations in order to price the company's securities. This number here, the $13,000 that you got from investing, is not persistent, right? You cannot keep selling your assets because eventually you're going to run out of assets. But it is important to see how much you're spending on your assets, because that's like capital expenditures. So this is money that you don't have a choice. You have to spend if you want to grow. Finally, it's good to know whether you're returning money to shareholders or whether you're raising money from shareholders to understand what stage of the business you're in. Younger companies are going to have negative cash flow from operations. They're going to have very negative cash flow from investing. And all of their money is going to be coming from these accounts. So all the money for younger firms is coming from selling your securities. So they're either going to be borrowing money from banks, or they're going to be selling equity, right? As companies become more mature, their capital expenditures will drop, and they're going to be starting, if they're successful, they're going to start generating cash flow from operations. And those two together will be enough to start paying back some of the money to creditors and to shareholders. If you have a mature company that is not generating cash flow from operations, well, then you're really in trouble, because how are they going to pay off all the maturing liabilities that they have? It becomes a big problem. So always want to look at the tree and adjust for the age of the firm in your thinking. But so for younger companies, it's okay to have negative cash flow from operations, but for more mature companies, it's going to be a serious problem. So in addition to the other statements, you definitely want to look at those too. Now, we said that, Starbucks is actually doing really well. They are a mature company. They're still growing quite a bit. So you can see they continue to buy. So they spend $1.3 billion on acquisitions, and they spend another $2 billion on property, plant, and equipment. So even though they're relatively mature, they continue to invest in their business, which is a good sign. They have a lot of cash from operations, so they can afford to give some their shareholders some money back. So they are actually issuing long-term debt. So they issued a lot of debt, probably because rates were attractive. And then they turn around and they spend the money on dividends and stock repurchases. So they spent more than what they raised because they have some extra cash this year from this deferred revenue account with Nestle. So altogether, even after everything they did, they still had an extra $6 billion at the end of the year. So their cash balance went from 2.4 to 8.7. So this is definitely a good thing to see. All else equal, right? We like to see that they have enough cash to give money back to shareholders like that. So they're successful. They're generating cash flow from operations.
Val, can you just show again where they spent more than what they received?
Yeah, right here. So they got five. So I'm just looking at financing for a second, right? So they got 5.5 billion from selling debt, but they returned almost $9 billion to their shareholders. So that's what I meant by saying they spent more than what they got from debt issuance. Right? Yeah, that's where this is coming from. But overall, they actually were left with extra cash at the end of the year. They did not spend all the money they got from operations. They only spent half of it.
So they were able to do that because of deferred revenue, the big bump, deferred revenue, correct?
Yeah, that deferred revenue allowed them to do a lot of repurchases. So you can actually see that if it wasn't for the deferred revenue number, repurchases would not have been so high, right? So though that $7 billion basically all went for repurchases. Right? So clearly they did not need that cash in their business, so they gave it back to buy back their shares. Yeah, and if it wasn't for that deal, then their repurchases would have been like $2 billion, most likely, something closer to prior years, because they usually run at the same rate. Right? So they increased their dividend and they did extra repurchases, all because of this extra cash. So they're returning it. As they make the money, they're giving it back to shareholders because they don't really need it in the business. They have plenty to grow the business and they have some money left over. Now let's look at another one. So if we go back and look at the cash flow for Merck, we can sort of do a similar interpretation. So the first thing you want to notice here is just like just like Starbucks, these guys are using the indirect method. So they start with net income. So net income was $9.7 billion from the income statement. And then look, they do the same thing we did, right? So they add back depreciation, amortization. They add back impairment charges because those are non-cash, right? They add back any expenses associated with their acquisitions of Peloton because these are non-cash expenses. And then after that, so they remove the amount of money that they end up paying extra for their deferred income taxes. They add back any executive compensation because that's given in shares, not in cash. And then they go through the current assets and liability accounts, just like we did, and they make adjustments. So accounts receivable went down by 294. So that's a good thing for cash. Inventories went up. That's a bad thing for cash, right? Accounts payable apparently went up. So that's a good thing for cash because you're not paying your bills right away, right? Et cetera, et cetera. So they're making the same adjustments as we did. And then they ended up with a cash flow from operations of 13.4 billion, which is much larger than this number. Usually the thing that accounts for the difference between net income and cash flow from operating activities is this one right here. Depreciation and amortization. The rest of the things tend to cancel out, right? You build up some assets, you build up some liabilities. but the depreciation is always there. So you can actually see across the years that the depreciation, when you add back depreciation to net income, you actually get something pretty close to cash flow from operations. You guys see that? So a quick and dirty way to do the cash flow from operations is just take your net income and add back depreciation and amortization. That will get you to something relatively close to the real number. But of course, you can just look at the real number too. All right, so they got this. So that's a good sign. Cash flow is doubled in the last 2 years, which is really amazing, right? So from $6 billion to $13 billion. And then in terms of investing, they continue to spend very heavily on capital expenditures. So that's a good thing to see, because this hopefully will generate even more revenue for them in the future. The difference between cash flow from operations and capital expenditures is sometimes called free cash flow. This is the money that you have to give back to your shareholders if you decide to, right? So that's a metric that's used in finance often to price the company's equity. So you have about $10 billion of free cash flow here for the company. Then they spend $3 billion in marketable securities. So this is where they park the money that they don't need, right, to make a little bit of interest. But then some of these securities actually matured, so that gave them an $8 billion inflow. So on average, they actually got $5 billion from these securities that are maturing. They spent $3.6 billion buying this company here, Antelic. They spent another $1 billion buying Peloton Therapeutics. This is not the bike company. This is another company. And they bought, some other firms of $294. So altogether, even after all the acquisitions, they still spend only $2 billion on investing, right? Because they got a lot of money from selling their securities. So $2 billion here they spent. In the prior years, they actually got money from investing, because they sold more assets than they acquired. And then moving down, so now we're down, let's see, 13 billion minus 2.6, so they still have about 10 billion of cash flow. So what do they do with it? Same thing as Starbucks. They buy back their shares and they pay dividends. But unlike Starbucks, they also paid off some debt. So you see net change in short-term borrowings, right? So they actually paid $3.7 billion of short-term debt that they borrowed the previous year. So they borrowed some money last year, now they paid it back. They issued some more debt, $4.9 billion. So they're not really paying off the debt, they're rolling it. The thing that matures, they just replace with new debt. And meanwhile, they just keep giving money back to shareholders. So 4.7, 5.6, altogether $8.8 billion back to shareholders. 1.9 is left, so that increases their cash balances to 9.9, right? So this is a very neat statement, right? Because it really gives you a view of managers' priorities and what is it that they do with all the money they generate. So that's this is probably my favorite statement among all of them in terms of information content. That and the income statement I spend most time on. The balance sheet, as we know, is somewhat dated, and it doesn't include intangibles. But this is a nice view of what's happening in the firm. Right. So this is another profitable business, right? I like what I see. Nice increase in cash flow from operations, lots of money going back to shareholders, so they are returning the money, they're not wasting it. I like the growth. There's quite a bit of a buffer behind $10 billion of cash just sitting there. Lots of marketable securities also. So clearly strong business from what I see. All right, so let me pause this. All right, so that just kind of gives you an overview, guys, of this. Again, as I said, none of this is going to be on the exam, but it is good to know. So I will still assign a few practice problems on module 11. They're going to be on the module 11 if you want to do them. I think it's going to help you going forward, but I understand if you don't want to do them because there's just not enough time. I will also assign practice problems on module 8, the things we talked about today. just so you can practice, because module 8 will be, on the final exam. So again, the final exam will be, let's see, there's going to be 5, 6, 7, and 8, right? So 4 chapters. Those are the things that we haven't done. So anything after the first exam is 5, 6, 7, and 8. And so that's a lot of material. So make sure you kind of review it well before you take the exam. And there will be a sample exam that's going to go live today. So you get to try it. Now on Thursday, this Thursday, I'm going to again hold the office hours. If you guys have any questions as you do the sample exam, stop by. I'll be there. I'll probably won't be there the next Thursday though, because that's kind of getting too late. So hopefully you figure it all out by then. But if you have questions, you can email me and I'll be happy to answer it going forward. Oh, okay, let me stop here. Any questions, doubts, concerns?
Can you confirm that we're going to be able to go back and forth on the questions on the final exam?
Yeah, it's been confirmed. Can hold me to that.
Just wanted to double check.
I will double check too how I set it up. But you guys still have to do it in one sitting, okay? So if the system for some reason kicks you out, you have, let's say your internet crashes, right? You get kicked out. Email me, but more importantly, go right back in because your clock keeps ticking, right? So this will create some serious issues if you don't go right back in. You can't just wait for 10 minutes and then go back, because I think the time doesn't stop if it kicks you out. But send me an email just so I know when I look at the log file.
Val,
Yeah.
I'm somewhat of a night owl, and I probably take the test around midnight or 11 p.m. How late are you up?
Well, you don't really need me. You just have to send me an email saying what happened.
Okay.
I think if it kicks you out, just make sure you go right back in, right?
Okay.
Just don't wait till the next morning to go back in. But hopefully it's not going to kick you out. It very rarely happens. So, but if it happens, we'll deal with it. I think you should be able, as long as your time is not up, you should be able to go back and continue.
Thanks.
But I am up until 12, usually watching Netflix, right? Right. Other questions?
This is related to the content, but is there an equivalent of stock options for companies that aren't publicly traded yet?
No.
Nothing like that. Okay.
I mean, those companies analysts can give you stock options. It's just you don't know what they're worth, right? Because the company is not publicly traded. But anytime they raise money through a private equity round, they give a valuation. And then sometimes the company may even be willing to buy them out from you at a given price. There's also now, they're starting to establish markets where you can trade those options even before the company is public. But there you have to be careful because you got to ask permission from the company whether you can sell your options or not. Sometimes they give permission and sometimes they don't. Of course, the game usually is that you keep your options until the company goes public, right? And when it goes public, then you'll be able to cash them out. That most people do it that way, right? They wait until the company goes public. And if it goes public and it becomes like, I don't know, Coinbase, then you will be a multi-millionaire and you can retire immediately. Right. So that's the nice thing about options. If this thing hits, you're set for life. Okay? So it's okay to take a little risk with them. Now you can buy and sell options on your own, but that's very risky. So be careful if you trade options on your own. Because you can make or lose a lot of money, usually lose. All right, so let me just, I think going forward, I'm out of time, but just to remind you, we have this investment club, where we meet. I know Marina, for example, is on it, right, Marina? So she gives us all the stock tips so we can all make money.
Not stock tips, but I can explain options.
There you go. So, we talk about options and different types of securities in that club on our meetings. But going forward in the fall, we're going to try to have it live. So maybe once a month, we're going to bring somebody to the school to kind of talk about different investment ideas that they may have. Hopefully, we're going to bring successful people. So just keep an eye on that. That's only for MBAs. It's called the 10X Club. So if you guys are interested in learning more about investing, then that would be there for you too. And then you can tell me how well Bitcoin has done since I didn't buy it, in that group. All right. So anything else left? I want to thank you guys for logging in every week, and participating. It's been fun. It's kind of hard to do it on Zoom, but I hope that in the fall I'll be able to meet you in person. So my plan is to be there. So I'm in Newark, so stop by, say hello, so I can meet you. I'm on the 9th floor if and when we reopen. But you'll probably see me around the EMBA tables. There's actually food in regular times. So there's like things like lunch and coffee, get to hang out. So I hope you get to experience some of that in the fall because it's a sort of a nice part of the program. But if I can be of any assistance going forward, definitely shoot me an email, let me know. But yeah, I really appreciate your effort and I hope you learned something in the class.
Thanks, Val.
If you learn something, then I'm happy.
Thank you, Val.
And I
That
wish
was
you good luck.
really great. Thanks for your commitment to teaching.
Thank you. It's my favorite thing to do in the job. So I appreciate you guys working with me, even during these times. Yeah. Thanks a lot. I'll let you go so you can have some lunch.
Thanks,
And
Val.
I'll see you around. Yep.
Yeah.
Bye.
Thank you, Val.
Thank you so much.